So we'll move to capital gain. After capital gain, see regarding PGBP head that we will discuss along with the assessment of company, we will discuss the provisions of PGBP. So now we are going to discuss the provisions of capital gain and then we will start the questions on capital gain. First of all, what are the major amendments happened during the year 24-25 in capital gain? The main amendment is the indexation benefit in respect of long-term capital asset has been abolished. If a capital asset is transferred after 23rd July 2024, on or after 23rd July 2024, indexation benefit is not available. But in respect of resident individual and HEF, there is an option in respect of land and building if it is acquired prior to 23rd July 2024 but transferred on or after 23rd July 2024 only for the limited purpose of computing tax rate, they will get the benefit of indexation. In those cases, if they are taking the indexation benefit as an option, that is only for the purpose of limiting the rate of tax. By claiming the indexation benefit after 23rd July for resident individuals and HEF in respect of long-term land and building, if that result into a loss, that loss they cannot set off, that they cannot carry forward. And further, if a resident individual or HEF claiming indexation benefit after 23rd July and computed capital gain, which there is a positive capital gain, they won't get the tax planning benefit of 54 or 54B or D or EZ or F, etc. Because the benefit of indexation is given as an option to reduce the rate of tax only and not for any other tax planning purpose. And the other major amendment is after 23rd July 2024, there is only two period of holding to determine long term or short term. That is only 12 months and 24 months. That 36 months time period has been abolished. So these are the major amendment in that basics area. So when it is come to the main provision of chargeability section 45 subsection 1, normal chargeability to attract a capital gain, there are two basic conditions. There must be a capital asset and it must be transferred. That is 45(1). The next provision is section 45 subsection 1A. Section 45(1A) says insurance compensation received for damage or destruction of a capital asset. You have a capital asset, but that capital asset is damaged or destroyed. The damage or destruction here means total damage or total destruction. It is not irrecoverable. It is not repairable. Total loss and total destruction. And that total loss or destruction happened due to natural calamity like a flood, typhoon, hurricane, cyclone or similar natural convention, riot or civil disturbance, enemy action, accidental or fire explosion. So due to any one of these reasons, your capital asset is damaged or destroyed and you got insured and you got insurance compensation, then capital gain under section 45 subsection 1(1)(a) arises. So full value of consideration shall be the insurance compensation money received from the insurance company, or if the insurance company gives you new asset, then fair market value of that new capital asset must be taken as the full value of consideration. If you are getting new asset plus money, then take that together. Fair market value of asset received from the insurance company plus money received. That must be taken as the full value of consideration, and from that reduce the cost of acquisition or index the cost of acquisition if eligible. You can reduce, balance will be the capital gain. But in practically, usually industries are taking insurance for their capital asset, especially plant and machineries, because it is a very costly machines. They will take the insurance to cover the risk. In those situations, there is a problem. Directly we cannot compute capital gain because it is a depreciable asset. Depreciable asset, we will claim depreciation under section 32. So in respect of depreciable asset, capital gain arises only when the money received or the insurance compensation received amount exceeds the opening WDV plus addition. That is, the block should be negative. So there is a block containing 5 machines and only one machine is damaged or destroyed, and you are got an insurance compensation that if that amount does not exceed the total block value, then there will be no capital gain. That insurance compensation can be reduced from the block and block amount will be reduced, and for balance amount you can claim depreciation. So regarding depreciable asset, to attract a capital gain under section 45(1)(a), the insurance compensation should exceed opening WDV plus addition. Because for depreciable asset, first we cannot directly compute capital gain. Always we should try to claim depreciation first, opening WDV. add actual cost of addition, less money received from insurance company, remaining block value. If that block value is positive and any other asset remains in that block, you can claim depreciation. If block value become negative, there will be capital gain. And regarding 45 subsection 1a, another issue is, if the insurance compensation received for damage or destruction of a capital asset, which is a depreciable asset, and block become negative, remember, such a capital gain is always short term in nature, because section 50 deals with the specifically depreciable asset capital gain provisions, which clearly says, even though the block is long term, that block you are holding for more than 24 months, then definitely that block is long term. But the capital gain from depreciable asset is always short term. Next issue, if the damage or destruction of capital asset is happened not due to flood, typhoon, hurricane, cyclone or similar natural convention, right, or civil disturbance, enemy action, it's not like that, right, or civil disturbance, but due to any other reason, the capital asset is damaged or destroyed and you got insurance compensation, there is no provision under the tax law to tax that receipt. That cannot be taxed, because section 45 subsection 1 is very specific that due to that 4 reasons, capital asset is damaged or destroyed, total damage, and you got insurance compensation, section 45 1a will be applicable. If the damaged or destroyed destruction reason is not due to any one of these 4 reasons, then remember, there is no provision under the tax law. It is a capital receipt which could not be taxable anywhere under the provisions of the income tax law. Next issue under regarding 45 1a is, if the damaged or destroyed item is a stock in trade, not capital asset, it is a stock in trade, then the insurance compensation received will be taxable under the head PGBP if you have business, and if business is also discontinued, then take it to income from other source. So either PGBP or income from other source, it will be taxable if the damaged or destroyed item is a stock in trade. So these are the points you have to keep in mind under section 45 subsection 1a. Then 45 subsection 2, conversion of capital asset into stock in trade. So not a core area, but sometimes they may ask a question regarding this along with the tax planning. So 45 subsection 2, if you have a capital asset which is converted into a stock in trade and later on that stock in trade is sold, then you are liable for 2 income, capital gain and PGBP income. Under section 45 subsection 2, the capital gain liability arises only at the time the stock is sold, but every details for computing capital gain we are using on the date of conversion only. Indexation benefit only up to the date of conversion only. Full value of consideration, fair market value of that capital asset on the date of conversion. Cost of acquisition can be claimed and indexation can be claimed only up to the date of conversion. But if the conversion of capital asset into stock in trade is after 23rd July 2024, no indexation. Before 23rd July 2024 converted, you can claim indexation, but indexation benefit available only up to the year of conversion. And when the stock is actually sold, you are liable for PGBP income also. So even though capital gain liability arises at the time of conversion of capital asset into stock in trade, but Act gives a time frame, or the liability is deferred until the stock is actually sold. So capital gain, all the computation figures we are using up to the date of conversion, but the computation actually has to be made only when the stock is actually sold. So if the stock is sold in part to part, then capital gain should also be computed in parts. So if stock is sold in piecemeal, capital gain also should be computed in piecemeal. So if the stock is not selling it, you are keeping it as stock, so it is taking a long time to sell the stock, no problem. Your capital gain liability can also be postponed. No need to pay any interest like that. When the stock is sold, okay, pay the capital gain tax. So if the stock is not sold, you are not liable to pay the capital gain tax. And the difference between actual selling price of the stock and the fair market value on the date of conversion, the difference is known as the PGBP income. So other words, we can say that the fair market value on the date of conversion, that figure will have double role. It will act as full value of consideration for capital gain purpose, and that same figure will act as cost of such a capital asset or cost of such a stock for the purpose of PGBP computation. And if there is any improvement carried on that capital asset after the conversion, see, after conversion obviously it is not capital asset, it is stock in trade. If any improvement carried out after conversion, it will be considered in PGBP only. It cannot be considered in capital gain. Now the next issue, practically people will convert land into stock in trade and they will construct some flat or apartments or a villa on that land, and then that villa or apartment will be sold. So that is a practical scenario. So in that situation, the entire property, that is the entire land converted, will not be sold. See, on that entire land, they will convert some 5 flats or 10 flats, and some part of the flats or some 2 flats or 3 flats will be sold. So only part of the total number of flats constructed will be sold. So in that situation, proportion at which that flats are sold should be applied on total capital gain computed, so that we will get the proportionate capital gain liable. Because if the stock is sold in part, capital gain should also be computed in part to part. That's the reason. Now, whether there is any tax planning is possible regarding section 45 subsection 2 under 54 or 54B or D or EC or F or G. Practically, in majority cases, people will convert capital asset into stock. The major example is land. Lot of other possibility. You are invested in shares and you have a lot of capital asset which is shares, and you are converted to and starting share trading business, and you are converting that investment of shares into stock and trade. In that case also, this section will attract. So you have a lot of jewelry as your capital asset, and you convert it into stock and starting a jewelry shop. In that case also, this is applicable. But usually the practical scenario, majority of the cases, land will be converted into stock, and on that land they will construct some apartments, and that they will be sold at a later point of time. So there will be PGBP and capital gain. In those cases, what is the tax planning possible? Usually for land, the tax planning possibly section 54 EZ is possible and 54F is possible. Regarding land, if the capital gain arises from land, so we can claim 54 EZ or 54F. If the capital gain arising from conversion of land into stock and trade and sold that land, the capital gain can be invested within 6 months in the long-term bonds, 5-year bonds of National Highway Authority of India Limited, or Rural Electrification Corporation Limited, or Power Finance Corporation Limited, or Railway Finance Corporation Limited within 6 months from the date of transfer. Maximum 50 lakhs you can claim that exemption. So that exemption is possible with respect to conversion of land into stock and trade, and later on that stock is sold. In those situations, a practical scenario, an issue arises. The issue is time limit to claim exemption under section 54 EZ is 6 months from the date of transfer. Usually in case of conversion of capital asset into stock and trade, the date of transfer is conversion. But here we are computing the capital gain only when the stock is actually sold, which is at a later point of time. So obviously that 6 months time period from the date of transfer would have been expired. So they are created a section 54H. So which says that in case of conversion of capital asset into stock and trade, to get the exemptions under the 54 series, the time limit should be counted from the date on which a stock is actually sold and not from the date of conversion. So under 45 subsection 2, we can claim exemption under 54 if the capital gain has been invested in the prescribed modes in those sections, and the time limit for computing the exemption will be started from the date of sale of stock only and not from the date of conversion. And after section 45 subsection 2, there is section 45 subsection 3 and 45 subsection 4 and 45 5 and 5A. So 45.3 and section 45.4, actually that provisions deals with the partnership firm, transfer of capital asset by partner to the firm, and reverse scenario along with the 9B, that we will make a separate discussion. After discussing all other things, we will come to that because that's very important for final. And then the next section is 45.5. Section 45 subsection 5 says that if there is a compulsory acquisition of a capital asset, capital gain arises. So capital gain has to be computed only in the financial year in which you actually received the compensation from the government. So even though compulsory acquisition happened in 2023-24, but you are getting the compensation only in 2024-25, then capital gain has to be computed only in 2024-25. So that is the first year in which any part of the compensation is actually received, you have to make the computation. There is two types of compensation. One is initial compensation, and if the person is not satisfied with that initial compensation, probably he will file case and court will increase the compensation. That is known as enhanced compensation. So there is a possibility of two capital gain at the time of initial compensation receipt and at the time of enhanced compensation receipt. Regarding initial compensation, capital gain has to be computed in the financial year in which any part of the initial compensation is first received by assessee. Sometimes initial compensation declared will be 50 lakhs, but you are getting only 5 lakhs. But when you received 5 lakhs, you have to make the computation for entire 50 lakhs. So when you are receiving the balance amount, no impact. And at a later point of time, if you filed a case for getting the increased compensation and court made the order and you are getting the enhanced compensation, for that amount also you have to make the computation in the financial year in which enhanced compensation is actually received. So in this case also, indexation benefit will be available only up to the year of compulsory acquisition. That is the year in which acquisition made, not up to the year in which compensation is actually received, right? Indexation benefit available only up to the year of transfer. Here the transfer event is compulsory acquisition, not the receipt of compensation. Even though we are computing the capital gain in the year in which compensation is received, but the indexation benefit is available up to the year of transfer, that is compulsory acquisition year. In compulsory acquisition cases, there is a special scenario. When we are filing case to get the increased compensation, sometimes the court will say to the government, give some amount immediately as a relief to the assessee, and court will pass an interim order, and assessee is getting money. But it's not the final order, just an interim order. And later on, the court again will come into meet and discuss the case, and finally they will decide. So this should be the enhanced compensation. So there will be final order. So regarding enhanced compensation, there is a possibility of interim order and final order. So you are getting some money from the government upon the interim order, but no need to compute capital gain for the enhanced compensation if you are receiving money under an interim order. You have to wait until the final order is made. Capital gain has to be computed only in the year in which a final order is made by the court. So that is another adjustment you have to keep in mind. Now regarding compulsory acquisition, probably you will get interest on compensation or enhanced compensation. That compensation or enhanced compensation, if you are getting any interest, that interest portion should be taken to income from other source. It is taxable under section 56. As per section 57, from the interest on compensation or enhanced compensation, you can claim 50% standard deduction, and balance 50% only will be taxable. So that is into income from other source. So compensation under capital gain, but interest will be always under income from other source. And from the interest, it will be assessee will be eligible to claim 50% standard deduction, because such interest is taxable on receipt basis. Even though that interest belongs to past 10 years or 15 years, that entire interest will be taxable at the time of receipt. So you are eligible to claim a 50% standard deduction. No other expense will be allowed. So what about legal expense? Okay, while computing capital gain, if you incurred any legal expense to get the compensation, that legal expense can be claimed as expense for transfer. If you incurred any legal expense to get the initial compensation, while computing the capital gain of initial compensation, you can claim legal expense there as an expense for transfer. And to get the enhanced compensation, again you incurred legal expense, that is also possible to claim as an expense from enhanced compensation. But remember, for enhanced compensation, while computing the capital gain, there is no cost of acquisition, there is no cost of improvement, because all those we already claimed from initial compensation computation. So this is a single capital asset, right? But we are getting the compensation in two ways, initial and enhanced. So at the time of computation of capital gain of initial compensation, that entire cost of acquisition and improvement we already claimed. So while computing capital gain for enhanced compensation, upon the court order, we are getting the amount. You can claim only legal expense, no other expense is possible. Under 45 subsection 5, if there is a compulsory acquisition happen, there is a tax planning possible, that is under section 54D. So 54D tax planning says that there should be a land or building used for industrial purpose for a minimum period of 2 years by the assessee. So 54D tax planning is available for every assessee, whether individual, HF, company, firm, LLP, everyone is eligible. So capital asset should be land or building used for industrial purpose for a minimum period of 2 years prior to the date of compulsory acquisition. So that capital asset, that is land and building used for industrial purpose, has been compulsorily acquired by the government, and you are getting compensation. So from that compensation, you computed the capital gain. To get the exemption, that capital gain must be utilized to purchase another land and building, or to purchase land and construct a building, either to continue the existing industrial undertaking or to start a new industrial undertaking within a period of 3 years after the date of receipt of compensation. So from the date of receipt of compensation, compute 3 years. So within 3 years, you can purchase another land and construct a building, or you can purchase a land and building. The purpose to continue the existing industrial undertaking or to start a new industrial undertaking. So cost of the new land and building can be claimed as exemption from this particular capital gain arising under section 45(5). So if before the due date for filing income tax return, you could not utilize that money to purchase land and building for industrial purpose, okay, do one thing, deposit that money in capital gain account scheme. The amount deposited in capital gain account scheme will be allowed as exemption now, subject to the condition that before the expiry of 3 years, it should be actually withdrawn and should be utilized for purchase of land and building for industrial purpose. If you did not utilize that money lying credit in capital gain account scheme within a period of 3 years, on the expiry of 3 years, that unutilized amount will be deemed as capital gain and it will be taxable in the previous year in which that 3-year time period expires. But suppose if assessee died before the expiry of 3 years and legal heirs withdrawn that money, then it is not taxable, because in the hands of the legal heirs, it has the character of a undivided estate of a deceased person, so it won't be taxable. But if assessee exists and did not utilize that money within 3 years for another land and building purchase, then definitely it will be re-taxable. So these are the points related to 54D and 45(5), both are connected. So if they are asking a question from 45 subsection 5, 100% sure it will be with the 54D. The tax planning 54D and 45(5) together they will ask. And for final point of view, definitely they will ask a question from the perspective of company or firm, because any assessee is eligible. And this land and building should be used for industrial purpose for a minimum period of 2 years. So definitely they will ask a question based on a company or firm, 45(5) plus 54D. Sometimes they are asking adjustment from compulsory acquisition along with assessment of company. Question says P&L account credited with some amount received upon interim order of court on compulsory acquisition and credited to P&L. So we have to reduce from the net profit, but should not make a computation on capital gain, because when you getting an amount received under interim order, capital gain liability does not arise now. Capital gain liability arises only upon making the final order. So simply reduce from the net profit and put a note, no capital gain computation. So in such a way also they are asking some adjustments. So that is 45 subsection 5. Now there is a section 45 subsection 5A, that is joint development agreement in respect of real estate project. That is 45 subsection 5A. So what section 45 subsection 5A says? So as per section 45 subsection 5A, if a person who is a individual or a chief having a land or building, so he entered into a joint development agreement with a builder to develop a real estate project on his land or building. So he will get some money as a consideration and some share in the developed project of the real estate, that real estate project. So he will get consideration in the form of share in new project plus some money. So he will transfer the land to the company by way of a power of attorney, something like that. And he will in return, he will get some developed area in that project once the project is completed, plus some money he will get. So that is section 45 subsection 5A. So in that situation they are saying capital gain liability has to be postponed or the computation should be deferred. Only when that real estate project is completed, we have to make the computation. So until then, even though you are getting money at the time of writing the power of attorney and land is handing over to the builder, even though transfer took place at that time, the moment you sign into the agreement and getting some money and handing over the possession of the land to the builder, but still no liability arises. Liability arises only at the time the real estate project on that land is completed by the builder. So at that time, how the capital gain will be computed? Stamp value of developed share received by this landowner plus money received shall be the full value of consideration. From that, we can reduce the complete cost of that land of the landowner. We will get the capital gain of the landowner. So that is 45 subsection 5A. Here also, under 45 subsection 5A also, tax planning is possible. So 45 5A with some tax planning also they can ask. So this is in brief 45 5A. So 45(1) general chargeability, 45(1)(a) insurance compensation for damage or destruction of capital asset, 45(2) conversion of capital asset into stock and trade, 45(3) and 45(4) partner firm related provision along with the 9B, 45(5) compulsory acquisition, and 45(5)(a) joint development agreement in respect of a real estate project. So these are the basic provisions, right? And now I will explain the tax planning. Once we explain the tax planning, we will straight away go to the problem covering these 45 and tax planning areas. Then we will go to the advanced levels or the final level, okay? So from these area, first section 54, you are aware, it's a very simple exemption. Section 54 available only for individuals and HEF. Transferred capital asset must be land or building used for, transferred asset must be a residential house property, which must be a long-term residential house property. So as per the amended provision, land and building will be treated as long-term if it is held for more than 24 months. Even prior to amendment also 24 months. So this residential house property must be held by an individual or HEF for more than 24 months. So such a long-term residential house property is transferred. So capital gain arises. That capital gain must be utilized for purchase or construction of another residential house property within India within the time limit. Time limit for purchase is within 1 year prior to the date of transfer or within 2 years after the date of transfer. Time period for construction is within 3 years after the date of transfer another residential house property. So how much house property is eligible for exemption under section 54 if we invest the capital gain in more than one house, whether it will be eligible. So the criteria, if the capital gain arising from the old residential house property does not exceed rupees 2 crore, then you are eligible to claim exemption in respect of 2 residential house property. If you purchase or constructed 2 house property within the time limit, you are eligible. If the capital gain from the old house property does not exceed 2 crore. But if the capital gain from the old house property exceeds 2 crore, then only one residential house property is eligible under section 54. And now, if the capital gain from the old residential house property does not exceed rupees 2 crore, 2 house property eligible, but that is an on-time option during the lifetime of an assessee. Only once. That 2 residential house property exemption under section 54 is possible only once. So once you already exercised that option, in future you cannot again claim that option. You will get only 1 house property is eligible for exemption in future. So that is an on-time option. If the old capital gain does not exceed 2 crore, 2 house property eligible. So if the old capital gain exceeds 2 crore, only 1 house property is eligible. So even though you are eligible only for 1 house property, but you are buying 2 or 3 or 4, no problem. Exemption will be available only in respect of 1 house property. So in order to prevent the practice of claiming this exemption by high net worth individuals, they created another provision. Maximum exemption under section 54 cannot exceed rupees 10 crore. So old house property capital gain is 15 crore, and that entire 15 crore you utilize to purchase another flat. The maximum exemption will be restricted to 10 crore and balance 5 crore will be taxable. So that is the basic idea of section 54. So capital gain arising from transfer of long-term residential house property should be reinvested in residential house property within India, either purchase or construct. If before the due date for filing IT return, that is before 31st July, or if the assessee is liable for tax audit before October 31st, assessee couldn't purchase the new house property or could not construct the new house, okay, then you can do one thing, deposit the amount in capital gain account scheme in the specified bank, and that amount deposited in capital gain account scheme will be allowed as exemption now, but subject to the condition that before the expiry of the time period, that money should be withdrawn and it must be actually utilized for purchase or construction of the residential house property. In case of purchase within 2 years, construction within 3 years from the date of transfer. And now, before the expiry of 3 years, if assessee died and that unutilized amount in capital gain account scheme is withdrawn by the legal heirs, it is not taxable in the hands of the legal heirs. And further, if you are getting any interest from capital gain account scheme, it will be taxable under income from other source. If assessee did not utilize the money for purchase of house property or construction of house property within the specified time period, then on the expiry of maximum 3 years, unutilized amount in the capital gain account scheme will be re-taxable in the hands of the assessee as capital gain. So these are the main provisions of section 54. And there is a subsequent condition. Once you claimed exemption under section 54, that new house property for which you claimed exemption, that should not be transferred within a period of 3 years from the date of purchase or from the date of completion of construction. That new house property should not be transferred within 3 years. So if you violate this condition, that is if you transfer that new house property within a period of 3 years, then while computing the capital gain of that new house, its cost of acquisition shall be reduced by the amount of exemption earlier claimed under 54. So automatically what happened is the new house property's cost of acquisition will be reduced marginally. Sometimes it will become 0. So the entire sale proceeds of the new house property will become capital gain. So that's the impact. So no direct retaxation if you violate the lock-in period condition. If you violate the lock-in period of 3 years, the retaxable situation is they are saying it will be reduced from the cost of acquisition of the new house. And newly acquired house property must be purchased or constructed within India. That is another condition under section 54. And under section 54, assessee can purchase the new house property in the name of the spouse, or it can be purchased in the name of the children. No problem, right? Act does not say that new house property must be acquired in the name of the assessee, or it should be constructed in the name of the assessee. There is no such condition. So even though the old capital gain arises to husband, and husband purchased a new house property by reinvesting the capital gain, but new house property registered in the name of the spouse, no problem. Exemption is available under section 54. So 54 exemption available only to individual and HUF, and it is applicable only in respect of long-term residential house property. From any other capital gain, this exemption is not possible. Now the issue is, under the income tax law, whenever you are transferring a land and a building, there is a section 50C. So definitely 50C will be applicable. So 50C says that if whenever you are transferring a land or building, if the stamp value fixed by the state government at that time exceeds 110% of actual sale price, actual consideration. So if the stamp value exceeds 110% of actual selling price, then stamp value should be deemed to be the full value of consideration. So since it is a house property, it's a building and land, section 50C will be applicable. So if they are asking a question on 54 along with the house property, then definitely there will be 50C adjustment will be there. So 50C is a common section for applicable for every land and building transferred as a capital asset. Section 50C will be triggered. But if the land or building is transferred as a stock in trade, then section 43CA will provide. So 43CA and 50C, literally the content of the sections are 100% same. But if you transfer land and building as a stock in trade, you are a property developer, real estate developer, then go to 43CA and PGBP. If it is as a capital asset, come to 50C. Both cases, the condition is same. If the stamp value fixed by the government is more than 110% of actual selling price, then stamp value should be deemed to be the full value of consideration in case of capital gain. In case of PGBP, stamp value should be taken as deemed sales. From that, reduce the cost or index to cost as the case may be, you will get the capital gain or PGP income as the case may be. Now, there may be a scenario, two stamp value prevalent on the date of agreement of this property and on the date of actual registration, because in real estate or in case of land and building transactions, usually it will take some time. There will be 2 dates. First, the seller and buyer will enter into an agreement to sell. Obviously, the buyer will pay some amount of advance to the seller, and registration will be happened at a later point of time. But there is a time gap between these 2 dates. In between, the state government, in order to increase the registration revenue, they will increase the stamp value. So obviously, the stamp value at the time of agreement and stamp value at the time of registration will be different. In 99% cases, stamp value at the time of registration will be more, stamp value at the time of agreement will be less, because by passage of time, the stamp value will increase, because market value of land will increase. That will not reduce. So stamp value at the time of registration will be more. Stamp value at the time of agreement will be less. So if there is 2 stamp value, so which stamp value must be taken? Because to compare the stamp value with actual sale price, whether to exceed more than 110% of actual sale price, we need a stamp value, but there is 2 stamp value. One is agreement date and at the time of registration. So the act gives a solution. If the buyer paid advance to the seller on or before the date of agreement, at the time of agreement or before the date of agreement, buyer should pay advance to the seller. And number 2, that advance should be white money. It should not be black money. So that advance should be paid by way of account pay check or account pay draft or other prescribed electronic mode like a debit card or credit card, NEFT, NEFT or RTGS, IMPS, UPA payment, Aadhaar payment, BHIM app payment. So electronic modes, the payment should be made, or account pay check or account pay draft. Even crossed check is ineligible. Bearer check is ineligible. Cash is ineligible. You should pay account pay check or account pay draft or other prescribed electronic mode. So if these 2 conditions satisfied, that is, advance should be paid on or before the date of agreement, and that advance should be paid by way of these 3 prescribed modes, then stamp value on the date of agreement need to be taken. No need to take the higher stamp value at the time of registration. Favorable to assessee. But if any one of these conditions is not satisfied, then we should take the stamp value prevalent on the time of at the time of registration should be taken. So this is the provision of 50C. And again 50C says sometimes people won't accept the stamp value fixed by the state government, they will go for dispute. So if the court reduced the stamp value due to that dispute, court made the order to reduce the original stamp value, then you can take that reduced stamp value. In that case also, reduced stamp value should be compared with the actual sale price. Whether this reduced stamp value exceeds 110% of actual sale price, then proceed with the 50C. Sometimes people will not go for dispute with the state government authority. They will go for dispute with the income tax authority. So income tax officer will refer the case to valuation officer, and valuation officer will revise the stamp value. If valuation officer increased the original stamp value, no need to take the increased stamp value. You have to take the original stamp value only. But if valuation officer reduced the original stamp value, then we can take that reduced stamp value of valuation officer. So these are the provisions if stamp value is disputed. So if the land or building is transferred as a stock in trade, we should apply 43 CA. Relevant head is PGBP. For instead of taking actual sales, we should take deemed sales, that is stamp value, if this 110% criteria satisfied. Remember, that is 43 CA. If the land or building, including house properties, transferred as a capital asset, come to 50C. Both the sections, the content is 100% same. Now, what is impact of the buyer? So, buyer will be in a trouble. If there is a application of section 43 CA or 50C on the seller, 100% sure the buyer will be suffered. In the hands of the buyer, the difference between stamp value and actual purchase price. See, buyer's actual purchase price means seller's selling price. Seller's actual sale consideration, that is buyer's purchase price. So, in the hands of the buyer, the difference between stamp value and purchase price, if that difference exceeds 50,000, it will be taxable as gift under income from other source. The official word is immovable property received for inadequate consideration. It will be taxable as a gift under section 56, subsection 2, subclause 10. So, gift will be taxable. So, remember, if seller liable for 43 CA or 50C, sure, 100% sure, the buyer will be liable for income from other source. But for the buyer, it should be a capital asset. So if it is a stock in trade for the buyer, there will be no income from other source, because to tax an item as a gift under income from other source, that item must be a capital asset for the recipient. So if recipient is also a real estate developer, there will be no income from other source. In all other cases, buyer will be liable for income from other source, immovable property received for inadequate consideration, or we can say gift. And further, the buyer will be liable to deduct TDS if the actual purchase price or stamp value, whichever is higher, exceeds 50 lakhs, he should deduct TDS under section 194 IA. So buyer will have two issues. One is income from other source taxability, and second, compliance burden, that is he has to deduct the TDS. But if actual consideration and stamp value, both figures are less than 50 lakhs, then TDS under section 194 IA not applicable. So these are the provisions regarding land and building and stamp value. And now 54 we discuss. So what is section 54B? 54B says urban agriculture land. Remember again, at the time of computing capital gain, definitely you should expect 50C adjustment because it's urban agriculture land. So rural agriculture land, we know it is not a capital asset. Rural agriculture land means a capital asset situated maximum beyond 8 kilometers from the local limits of a municipality. So that is rural agriculture land. Rural agriculture land is not a capital asset. So urban agriculture land is a capital asset. Or we can say agriculture land is situated in specified area. Specified area means urban area. So that is within 2 kilometer or 6 kilometer or 8 kilometer from the local limits of a municipality plus the jurisdictional area of a municipality having a minimum population of 10,000. So that urban agriculture land should always be treated as capital asset. So if you transfer an urban agriculture land, there will be capital gain, but you can claim a tax planning 54B. Condition, assessee must be individual or HEF. Minimum 2 years prior to the date of compulsory acquisition, prior to the date of compulsory, not the compulsory acquisition, transfer, right, by way of sale. If it is a compulsory acquisition, no need to compute any tax planning because it is exempted as per section 10 subsection 37. Urban agriculture land used for agriculture purpose for a minimum period of 2 years, and it is compulsorily acquired by government, and assessees individual or HEF, it is exempted. Unconditional exemption, 10 subsection 37. But if it is transferred by the assessee by way of sale, okay, in that situation, capital gain arises, but you can claim tax planning 54B. That capital gain arising from transfer of urban agriculture land should be utilized for purchase of another agriculture land within a period of 2 years prior to the date of, within a 2 years from the date of receipt of actual amount, that is from the date of transfer. So within 2 years from the date of transfer, the capital gain must be utilized for purchase of another agriculture land. So here there is a double tax planning is possible. So you can purchase a new agriculture land in rural area so that you can claim exemption from urban agriculture land, and then that rural agriculture land you can transfer even the next day, or you can transfer even the next year. The lock-in period condition not applicable here because it is a newly acquired land is rural agriculture land. Rural agriculture land is not a capital asset. So sometimes assessee will sell a capital asset which is an urban agriculture land situated in urban area. That capital gain will be utilized to purchase rural agriculture land within 2 years. He will claim 54B exemption, and then that rural agriculture land will be again transferred. So nothing can be taxed. So no tax because rural agriculture land is not a capital asset. But if he is purchasing again urban agriculture land and he claimed section 54B exemption, lock-in period will be triggered. Newly acquired urban agriculture land should not be transferred within a period of 3 years. So if that condition is violated, then the capital gain exempted earlier will be reduced from the cost of acquisition of that new agriculture land. So always it is better as a tax planning, transfer urban agriculture land, reinvest in rural agriculture land, and then sell it. There is no tax. So this is section 54B. So here also remember, for urban agriculture land there will be 50C. 50C at the time of taxing, computing the original capital gain, there will be 50C because it is agricultural land. It's a land. So 50C will be triggered. Now 54D. We already discussed 54D, that is 45 subsection 5, compulsory acquisition of land and building used for industrial purpose for a minimum period of 2 years, and which is compulsory acquired by government. You got a capital gain. That capital gain can be reinvested to purchase another land and building to continue the industry or to set up a new industry. You can claim 54D exemption. There also capital gain account scheme is also available. In all sections, capital gain account scheme is available except section 54F. 54EZ. Under 54EZ, there is no capital gain account scheme. In all other sections, capital gain account scheme is available. So now what is next tax planning? 54EZ. Long-term land and long-term building transferred by any assessee. Remember, 54 exemption only to individual and HEF, 54B only to individual and HEF, 54D any assessee, 54EZ any assessee, 54F individual and HEF, 54G any assessee, GA any assessee. So 54EZ any assessee. But the transferred capital asset must be long-term land and long-term building. So it is transferred and capital gain arises within 6 months after the date of transfer. Within 6 months from the date of transfer, capital gain should be invested in long-term bonds of National Highway Authority of India Limited or Rural Electrification Corporation Limited or Power Finance Corporation Limited or Railway Finance Corporation Limited within a period of 6 months from the date of transfer. So such amount deposited in these bonds will be allowed as exemption under section 54EC, maximum 50 lakhs. So maximum exemption cannot exceed 50 lakhs. And these bonds should not be transferred within a period of 5 years, or it should not be converted into money. That means this bond you cannot pledge as a security to obtain some loan. You cannot mortgage. So next 5 years, physically that bond should be available in the name of the assessee. And again, it should not be transferred within a period of 5 years or should not be pledged. So if this condition violated, exemption given earlier straight away will be retaxed. That is 54EZ. So simple exemption, maximum 50 lakhs. And from these bonds, you will get some interest return that will be taxable under income from other source. So after the expiry of 5 years, you can redeem the bond and there will be no tax liability. Only the interest income will be taxable under IFOs. So that is 54EC exemption. Now, what is section 54AF? So 54F is a very interesting section. No direct exemption, only proportionate exemption is available. 54F says that you should be a individual or HEF. You are transferring a long-term capital asset, any long-term capital asset that should not be a residential house property. That should not be a residential house property. Okay, you can transfer land, or even you can transfer commercial building, or you can transfer jewelry, share, okay, whatever capital asset, but it should not be a residential house property. And such capital gain arises, computed the capital gain. From that, the net sale consideration from the transfer, not the capital gain. Here the investment should be made out of the net sale proceeds. So the net sale proceeds means full value of consideration minus brokerage or expense for transfer, that is NSC. The NSC must be utilized to purchase another, only one residential house property within India. So that one residential house property is a strict condition. If you purchase two house property or construct more than one house property, you are totally ineligible for this exemption. Even for that one house property, exemption is not available if you violate this condition. So it's a strict condition. Under section 54F, only one house property should be purchased or constructed within a period of 2 years and 3 years. Before the expiry of that time period of 3 years, you should not purchase any other house property or construct any other house property except the eligible one. So that is a strict condition. So only one house property should be purchased or constructed. Then the exemption will be allowed proportionately out of the net sale consideration. How much amount is used for purchase or construction of the one residential house property? That ratio should be applied to capital gain. Only that much amount is allowed for exemption. So we can say that long-term capital gain from old long-term capital asset into numerator cost of the new house or amount deposited in capital gain account scheme divided by in denominator NSC, net sale consideration. So we will get the exemption amount. So to get the full exemption of capital gain, the only way is you have to utilize the entire net sale proceeds to purchase or construct one residential house property in India. Here also there is an amendment in numerator, in the numerator of that formula, that is capital gain into cost of the new house or capital gain account scheme divided by NSC. That numerator amount should not exceed 10 crore. So in the numerator, the amount should not exceed 10 crore. Cost of the new house or capital gain account scheme deposit amount cannot exceed 10 crore. So this is section 54F. Newly acquired house property for which exemption claimed under 54F should not be transferred within a period of 3 years. If this condition is violated, the consequence is direct consequence. Whatever exemption given earlier under 54F, directly taxable, plus capital gain of the new transfer computed separately. So there will be two capital gain. You transferred the new house property within 3 years. So the new capital gain should be computed for that transfer, plus earlier exempted capital gain will be directly retaxable. But in all majority of the all other sections, it is not like that. If you violate the lock-in period condition while computing the new capital gain, exemption given earlier will be reduced from cost of acquisition. But in 54EZ and 54F, it is not like that. So in these two sections, directly it will be retaxable. This is 54F. Now 54G and GA, both you can study together. 54G means land, building, plant and machinery used for industrial purpose in an urban area is transferred due to the transfer of industrial undertaking from urban area to non-urban area, or we can say rural area. 54GA says shifting of industrial undertaking from urban area to special economic zone. So in both sections, capital gain should be emerging from transfer of land, building, plant and machinery used for industrial purpose in urban area. Such a capital gain must be utilized for purchase or construction of another land, building, plant and machinery, and incurred for shifting expense in connection with the shifting of plant and industrial undertaking from urban to non-urban area or rural area, that is 54G, and 54GA from urban to special economic zone. The difference between 54G and GA is under 54G, shifting from urban area to non-urban area, to claim the exemption under 54G, newly acquired plant and machinery must be new plant and machinery. If you purchase second-hand plant and machinery under 54G, exemption not available. Second-hand plant and machinery not eligible. But in 54GA, even second-hand plant and machinery is also eligible. That is the only difference between G and GA. All other things are same. Capital gain from transfer of land, building, plant and machinery, reinvestment in land, building, plant and machinery, shifting expense. One-to-one correlation is not required. Capital gain from land can be used for investment in plant and machinery, or plant and machinery capital gain can be used for spending in shifting expense. That is also possible. One-to-one correlation is not required. But the only thing is, if Assassi is a company, then we should see which is better, whether to claim exemption from long-term capital gain first and to claim exemption from short-term, or whether to claim first from short term and then from long term. Usually, if the rate of tax applicable for the company is 25 or 30%, then always it will be better first to claim the exemption from short term capital gain, because it is an industrial undertaking. So the capital gain from building will be depreciable asset, short term. Capital gain from plant and machinery, depreciable asset, short term. Land will be long term. So first to claim the reinvested amount, that is land, building, plant and machinery, shifting expense. Take the total. This is the amount eligible for exemption. First, this amount should be claimed from short term, from plant and machinery and from building. Remaining any capital gain still available, that you can claim exemption from long term capital gain, so that the tax liability of the company will be minimum. So that should be keep in mind in 54G and GA. These are the tax plannings available. So now we can go to the question, and there are certain case law, a lot of case laws are there, so that you should go through. One of the important case laws in 54 easy is within 6 months assessee was ready to buy the bond, but the bond was not available with the bank, so he deposited the money temporarily with the bank within 6 months. Once the bond is allotted, he purchased it, but by the time bond is allotted, that 6 months time period is expired. Assessing officer denied the exemption. Assessee approached the court. Assessee is saying, it is not my mistake. I am ready to invest within 6 months, but the bond was not available. That is not my mistake. And again, I invested that amount with the bank. And once the bond is allotted, the bank transferred that money into the bond. That is after 6 months. So exemption should be given. So the court says no problem. If assessee was ready to invest the amount within 6 months, but bond was not available, it is not his mistake. So the time period of 6 months should be interpreted in a liberal manner. If it is not due to the negligence of assessee, exemption should be given. And in 54, we can say the case that is, as we discussed, sometimes assessee will transfer the old residential house property, but the new house property will be purchased in the name of spouse or maybe children, or in the joint name of assessee and spouse. No problem, exemption should be given, because to claim exemption, registered ownership in the name of the assessee is not compulsory. It is not mentioned anywhere under the exemption provisions. So that is not a condition. Now 54B also same condition, same rule we have to keep in mind. Newly acquired agricultural land may be in the joint name of assessee and spouse, or maybe in the name of son. No problem, exemption is available. And in 54 easy, one of the major point you have to keep in mind is this one, that is within 6 months assessee was ready to invest, but it was not possible because bond was not available. So he invested after 6 months. Exemption should be given. It is not his mistake. Another important point you have to keep in 54 easy is, 54 easy says that capital asset should be long-term land and long-term building. So if a company engaged in business using factory building as the depreciable asset, and that factory building is keeping for more than 24 months, then that block will be long term. But by virtue of section 50, capital gain from depreciable asset or block of asset is always short term. So the question is whether 54 easy exemption is available against depreciable block of building, factory building, whether it is possible. So 54 easy section says that asset, capital asset must be long term. 54 easy not says that capital gain should be long term. No. It says capital asset should be long term, and that capital asset must be long term land and building. Section 50 says that always the capital gain from depreciable asset, WDB mother, depreciable asset capital gain always should be treated as short term. So 54 easy does not say that gain should be long term. It says asset should be long term. So if the block of asset of building held for more than 24 months, block is long term. So you satisfy the condition of 54 easy. Even though capital gain is short term, you can invest in bond and you can claim exemption. So from depreciable block of building, 54 easy exemption possible, provided that block should be long term. That same case law we can apply under 54F also. 54F also. 54F says any long-term capital asset other than residential house property. So even long-term plant and machinery, furniture and electrical fittings, intangible asset, depreciable building, right? It is transferred. And capital gain is short term. You can claim 54F exception if the net sale proceeds is invested in to purchase one residential house property. But 54F is available only for a businessman who is an individual or a chief. But 54 easy even can be claimed by companies also. So that is another important case laws in that two sections, 54 easy and F. And 54G and GA, there is a case law is there. Except 54 EZ, in all other sections, capital gain account scheme is available. But in 54G and GA, sometimes the company in order to purchase the new plant and machinery for shifting the industrial undertaking, they will give some advance to the supplier. But plant and machinery is not received before the due date for filing IT return. But they give an advance to purchase the plant and machinery. So department is saying you didn't actually purchase it, simply you give the advance, so exemption will not be given. So they approach the court. So the court says no, there is no such condition. It should be utilized for purchase of plant and machinery. Act doesn't say you should purchase the plant and machinery and put to use and start the new industry. No, nothing like that. It should be utilized for purchase of another land, building, plant and machinery, shifting expense for the new industry or to continue the existing industry. That's it. There is no put to use condition. There is no actual possession of machinery, nothing like that. So if you give advanced for purchase of new plant and machinery, but before the expiry of 3 years, you are getting that plant and machinery, no problem. You are eligible to claim exemption as far as the ultimately plant and machinery is received. Now, if you give advance for purchase of plant and machinery, that will be treated as an exemption under section 54G or eligible for exemption, G or GA. So these are the major case laws related to those areas. Now we can start our questions, right? So we will start from here. Question number 15. In between, there is a small question, that is equalization levy, electronic commerce, that we will discuss later. Following are the details of income provided by Mr. Singh, the assessee, for the financial year ended 31st March 2025. So in this question, we will cover income from house property also. The first part of the question is completely house property. Second part is capital gain with the tax planning. So rental income from property at Bangalore 3 lakhs, standard rent 2,50,000, fair rent 2,80,000. It is a let out property. Municipal and water tax paid during the year, current year tax 35, arrear paid during the year, that is 1,50,000. So it is let out house property, current year municipal tax paid 35,000 and arrear is 1,50,000. Remember the rule of house property. If you paid municipal and water tax either for the current year or for the arrear, whatever is paid, it will be allowed. Except advance or prepaid municipal tax, not allowed. Arrear paid in the current year, allowed. Current year paid, allowed. Only paid will be allowed. So entire 1,85,000 you can claim. So what is house property computation rule? I think you remember that computation rule. Municipal value and fair rent, whichever is higher. So there is no municipal value. So fair rent you should take 2,80,000. That should be compared with the standard rent. Take the lower, that is 2,50,000. That is a reasonable expected rent. Compared with the actual rent, whichever is higher, is the GAV. So GAV 3 lakhs. You computed, right? GAV 3 lakhs. Now municipal and water tax paid 1,85,000 we can reduce to get the NAV. So GAV 3 lakhs and reduce the municipal tax paid 1,85,000. So we will get NAV, net annual value. That will be 1,15,000, right? 1,15,000, right? Yeah. Less deduction under section 24, 30% of net annual value. How much? 34,500. So balance from this let out property, we will get the income. 80,500 is the income from house property. So sorry, there is interest also there, right? Sorry. I didn't read the question completely, right? Okay, there is interest on loan. See, it is a let out property, so complete interest you can claim. No need to worry about whether it is a repair or renovation or purchase or construction. Okay, that restriction is only for self-occupied. For let out, there is no restriction. Entire interest you can claim. So interest on loan for repair 1,50,000. That entire 1,50,000 we can claim. So it will result in the loss, right? Yeah, it is separate. We will do. Let out is separate. Arrear and that is unrealized and we will do separately. So what is here the loss from this let out property? 69,500. Loss from let out property 69,500. And now arrears of rent of 30,000 received during the year which was not charged to tax in earlier. As per the provisions of section 25A of income tax law, if arrear rent or unreleased and subsequently recovered, which was not taxed earlier, it should be taxable under HP. You can claim only 30% standard deduction, no other deduction possible. So 30% we can reduce. So out of this 30,000, we can reduce 30%. So balance will be 21,000. This is positive income. So inter-source set off, we can set off in between. So net income from house property will be again loss, right? 48, 500. This is the loss from HP. So the first part is house property, right? You can expect house property computation only in case of either NR taxation, non-resident individual, which is an NR, they can ask for computation of tax liability, or you should expect HP in there only, double taxation relief problems. Otherwise, they won't ask HP. Or there is another possibility, company assessment question, P&L account of the company credited with the rent from property. So there will be HP computation. Otherwise, they won't ask HP. So here loss is 48,500. Keep that loss, because probably if we have other income, we can set off. Because HP loss, if it is current year, we can set off with other heads. But if assessee is default tax regime, opting for default tax regime, not possible. If it is opt out, it is possible. Now, the question clearly says he opt out of the default tax regime. Read the last sentence, opt out. So we can set off this HP loss. So keep that loss. The second paragraph is completely capital gain. Further, the assessee furnished the following additional information regarding the sale of property at Chennai. Mr. Singh's father acquired a residential house in April 2006 for rupees 1,25,000. Thereafter gifted this property to the assessee, Mr. Singh, on 1st March 2007. So, if a capital asset is received as a gift or will or inheritance or irrevocable trust or partition of HEF, if you get a capital asset in those scenarios, for subsequently you are transferring, cost of previous owner must be taken as cost of assessee. Holding period of previous owner should be taken as holding period of assessee, and holding period of the previous owner, you can claim indexation also if we follow the Bombay High Court decision in Manjula J. Shah's case. So here cost of this previous owner 1,25,000 must be taken as the cost of Mr. Singh. The property so gifted was sold by Mr. Singh on 10th June 2024. 10th June 2024, before amendment day, before 23rd July, we can claim indexation. The consideration received was 25 lakhs. Stamp duty charges paid by the purchaser at the time of registration 13%. So it is a data to calculate the stamp value, reverse calculation. If stamp duty paid 3,90,000 is at 13%, then what will be the 100? That is known as the stamp value. So what is the stamp value? 30. So this 30 lakhs is the stamp value. This is the stamp value. So actual selling price is 25 lakhs. So 25 lakhs into 110% will be 27 lakh 50,000. So the stamp value exceeds 110% of actual sale price. So stamp value should be taken as the full value of consideration. So full value of consideration 30 lakhs. And we should put a note on 50C. Out of the sale, and then we can compute the capital gain, right? Less indexed cost of acquisition. That is indexed cost of acquisition. Here the property's original cost is 1,25,000. Cost of previous owner 1.25 lakhs divided by 2006-7 indexation into current year indexation. You have the indexation? No. Okay. We need which years? 2006-7. We'll see if there is an indexation. Yeah. So 2006-7, right? 6-7, right? 122, 6-7, 122, 24-25, 363. One double two into 363. So what is the indexed cost of acquisition? 1,25,000 divided by 122 into 363. How much? 3.71926. Yeah, it's okay. 3.71926. Correct, right? Less. Okay, then now we will get the long-term capital gain before tax planning. So long-term capital gain is 26 point. Yeah, 28. That's enough. That's enough. 26.28, right? Long-term capital gain. Now there is some tax planning details here given. Out of the sale consideration received on 2nd January 2025, during the previous year, Assassi had purchased 2 flats. The investment was made by separate sale deeds, amounts being 8 lakh and 7 lakh respectively. Okay, here the old capital gain does not exceed rupees 2 crore, only 26 lakh something. So it does not exceed 2 crore. Assassi eligible for 2 residential house property as exemption. So these both house is eligible for exemption under section 54. So under section 54, 8 plus 7, 15 lakhs. 54 exemption. Now on 10th October 2024, the transfer is actually made on that is 10th June 2024. This is happened in October. So July, August, September, October, within 6 months. So eligible, invested in NHA bond, 10 lakhs. So under section 54 easy, he can claim exemption of rupees 10 lakhs. So balance is the long-term capital gain after exemption, which will be 1.28, right? Now this is the long-term capital gain after tax planning. Now we can think about the set off. There is a house property loss is there. So less HP loss, as Assassi is opt out of the default tax regime, set off is possible. So HP loss. So what is HP loss? 48,500, right? Yeah, 0.485 lakhs. So balance is the total income of Assassi or taxable income of Assassi. What is the final answer? 0.7957 lakhs is the taxable income. So it's a typical question. It contains 50C, it contains HP, it contains 54, and it contains 54 easy. Now, earlier we discussed the concept of joint development agreement in respect of a real estate project. So the next question is application of that provision. So earlier it was introduced in INDER also, but later they eliminated that from the INDER syllabus. And now it is available only for final only, right? Section 45, subsection 5A. Real estate project under a joint development agreement, JDA. So this section says a landowner is there. That landowner will be an individual and he is transferring his land to a real estate company to develop a project. So in lieu of that, the company will give developed project, some share in the developed project. That may be some commercial area or maybe some flat. If it is residential will be given, and some money also will be given. So here the problem is, if I transferred my land to a joint under a joint development agreement to a real estate company, the agreement will be entered in 2024-25, for example. They will give me some money of 50 lakhs or 1 crore. The project will start, piling work, then structure. So by the time the project is finished, it will take minimum 3 to 4 years. So the question is, when I am liable to pay the tax, because my consideration completely I will receive only when the project is finished, because once the project is finished I will get some developed area. Now I get only some part of the consideration as money. Remaining I will get only the project when the project is completed. So the question is, at what point of time capital gain will be computed, because it's a very complicated area because of timing issue. So a lot of practical disputes. So they created this provision. They are saying, if a landowner transferred his land to a real estate company for developing a real estate project, even though he is getting money earlier point of time and he put in an agreement and signed the agreement and hand over the land for developing to the builder, no need to compute the capital gain now. You should wait until the project is completed. Even a part of the project is completed, that's enough. So in the first year in which part of the project is completed, you have to compute the capital gain. Okay. So how the capital gain will be computed? That is money consideration received from the builder plus stamp value of his share, landowner's share in the real estate project on the date of issue of completion certificate of the new project should be the full value of consideration. From that, reduce expense for transfer brokerage, if any, you will get the NSC, reduce cost of acquisition of the land or building transferred, you will get the capital gain. Now, to give this advantage, to get the benefit of 45(5)(a), because 45(5)(a) is actually a benefit because you can defer your liability till the completion of the project. Maybe 5 years, 6 years, 7 years, 8 years. Until the completion, no need to pay the capital gain tax. Actually, transfer happened at the moment you signed the agreement and received some monetary consideration. Partly the transfer is completed, but capital gain should be computed only when the project is completed or finished. The problem is, to get this advantage, there is a strict condition. The landowner should not subsequently transfer his share in the new project to any other third party before the completion. Because sometimes the people will transfer their share in the new project even before completion of the new project. That should not be happen, right? If that is happening, this provision is not applicable. Go to the original agreement signing date, you have to compute the capital gain as per the general provisions of the income tax law. So to get the advantage of 45 subsection 5(a), the landowner shall not transfer his share in the new project before the completion certificate is issued by the government. Then this way we can compute the capital. So this is the provision. Usually here the underlying capital asset is land. So tax planning is also possible from this particular capital gain arises. If it is long-term capital gain, he can further try for tax planning. It's a land, right? So the possible tax planning is he can compute claim section 54 easy is possible. 54F is possible. F and DC is possible from this particular capital gain. Okay. Now we can go to that question. So Miss Mishika has entered into an agreement with Messrs. CVM Build Limited on 25th April 2017. This is the joint development agreement signing date. Actually not relevant because at that time no liability. In which she agrees to allow such a company to develop a shopping mall on land owned by her in New Delhi. She purchases such a land. This is the cost of acquisition of the land, 15 lakhs in 2009. And in consideration, Messrs. CVM Build Limited will provide 20% share in shopping mall to Mishika. 20% share in the developed mall. The certificate of completion of the shopping mall was issued by authority as on 26th December 2024. Remember, 26th December 2024 means it is after the amendment date of 23rd July 2024. So in this case, even though they are giving indexation, we cannot claim the indexation benefit. Indexation is not possible. On such a day, stamp duty value of shopping mall was 4 crore 14 lakhs. Subsequently, on 18th March 25, she sold her 15% share in shopping mall to Mr. Kedav in consideration of 65 lakhs. Okay, subsequently, after receipt of that share, again, subsequently it is transferred. So there will be two capital gain. Original capital gain, and again there is a new short-term capital gain for the transfer of that shopping mall share received by this associate. She has also purchased a house on 9th May 2024 in consideration of rupees 46 lakh and occupied for own residence. That is, in between she acquired a house property also. There is a possibility of 54F exemption. Compute GTI of Ms. Mishika for assessment 25-26, assuming that she has opted out from the provisions of 115 BAC. Okay, so we can compute the capital gain. Here, the associate did not transfer her share before the completion. Only after the completion transferred. So we will get the benefit of section 45 subsection 5A. What is the full value of consideration? Money received plus stamp value of his share in the new project. Here there is no monetary considerations received, only 20% share in shopping mall. The stamp value is 4 crore 14 lakhs into 20% received. So 4 crore 14 lakhs into 20%, how much? 82 lakh 80,000 plus cost of acquisition. As the transfer date is 26th December, after the amendment date, indexation not possible. So we are not claiming indexation. So cost of acquisition is 15 lakhs. The entire cost of land should be taken because once land is handed over, there will be undivided interest. Owner does not get any balance share back. So entire cost should be reduced, 15 lakhs. So what is the long-term capital gain? 67 lakh 80,000. Plus we can claim exemption under section 54F because it's land. Assessee is individual. And land capital gain in NSE used to purchase another house. So straight away she can claim a 54F exemption. So capital gain 67.8 lakhs into numerator cost of the new house that is purchased for 46 lakhs. 46 lakhs divided by NSE. NSE is 82.8 lakhs. So what is exemption under 54F? 67 lakh 80,000 into 46 divided by 82.8. 37.66. So balance is the long-term capital gain taxable. She can do one thing, balance amount can be invested in NHAI or RECL bond so that she will get 54 easy. But anyway, here no such data is given. So balance amount, what is the balance amount taxable long-term capital gain? 67.80 minus 37.66. 30 lakh 0.13. This is long-term capital gain. Now, the share obtained under this project is subsequently transferred by her, which is subsequently transferred by her, the 15% of her share. See, actually she is getting 20% of the total mall. 15% of the mall has been subsequently transferred, 15% share transferred for 65 lakhs. So there will be a short-term capital gain that should also be computed. So here the short-term capital gain will be full value of consideration is transferred for 65 lakhs. Now, cost of acquisition. You should be careful. This 82 lakh 80,000 is actually 20% of the total mall. Then what is for 15? So do not apply directly 15% on 4 crore 14 lakh because it will be undivided interest in a mall. Once mall is developed, you are getting 20% share. You cannot sell that 20% share directly allocating a particular area. That is not possible. So 82 lakh 80,000 is 20% of shopping mall. Then what will be 15% of shopping mall? 62 lakh 10,000, right? Yeah, 62 lakh 10,000 is the cost. So that should be careful. Short-term capital gain arise, which will be 2 lakh 90 or 3 lakh 2 lakh 90. So short-term capital gain plus long-term capital gain is the total income. Total income. So what is the total income? Yeah, 34, right? 33.03. Yeah. So subsequently, if the share obtained under a real estate project is again transferred, its cost of acquisition shall be stamp duty value or stamp value at the time of completion. That is earlier full value of consideration 82 lakh 80. That is actually the cost. If entire her share is transferred, only 15% is transferred. That is why proportionately we are taking. So this is section 45 5A application. If they are asking a question, it will be like this. Okay. But the only difference will be there will be some another tax planning also possible. Here it is 54F. Yeah. 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 Yeah, stamp duty is paid as a percentage of stamp value. No. Who is paying stamp duty? Stamp duty is paid by buyer, right? Not the seller. Expense for transfer means expense incurred by the seller. So next, section 45 5A is over. Now we will go to section, another important section for final, 50 double A. 50 double A. Yeah. 4 crore 14 lakhs into yeah, that's correct. But some students will try to apply 15% of 82 lakh 80,000. Yeah, that's I meant that, because actually it was a previous exam question. There is examiner's comments, right? In that comments, they are specifically saying majority of the students made a mistake. They directly calculated the cost of 15% applied on 82 lakh 80. I meant that, right? Yeah, if you take on the 100 directly 15, we will get the same answer, correct. Now we are moving to, see, I'm going to delete this. Okay, no, you okay with it, right? Yeah. Now, first I will explain the theory of section 50 AA, and then we will go to the question. So this is a recent section added. So they never tested it in final in a detailed level. So at any point of time, you should expect this section. This is very important. Actually, it's a deeming section. 50 AA. 50 depreciable asset capital gain provisions are mentioned in 50. Always the capital gain from depreciable asset is shorter. That is 50. 50A straight line method asset in power generating sector, just like normal capital asset, no difference. That is not important. 50A. 50 AA computation of capital gain in case of MLD, market linked debentures and specified mutual fund. Specified mutual fund and MLD. This section 50 AA says always irrespective of the period of holding. Remember, irrespective of the period of holding, capital gain from these three securities should always be treated as shorter and no indexation at all. So 50 AA is a specific deeming provision which says that those securities listed under this section, while computing capital gain, always it should be treated as short term irrespective of the period of holding. Further, under this section, capital gain arises even at the time of redemption. Okay, not only the sale, transfer by way of redemption also covered, either by way of sale or redemption. And three securities are covered. And all these threes are came into this section at different point of time. So amendment date is very important. So coverage, three securities. Number one, units of specific mutual fund. But the date is very important. That specific mutual fund or specified mutual fund covered under this section only if it is acquired, invested after on or after 1st April 2023. Specified mutual fund, they defined further. Specified mutual fund means a mutual fund which investing its proceeds not more than 35% in equity shares of domestic company. So basically it is a debt instrument, we can say like that. Basically it is a debt. To prove that, they are putting the condition, its proceeds, mutual fund is collecting money from the investors, its total proceeds, maximum 35% only should be invested in equity shares of domestic company. Balance should be invested in debt instruments. That their idea is like that. It's actually a debt instrument. So if it is more than 35% they are putting in equity instrument, then it will be treated as a normal long-term capital asset. And if they are putting more than 65% in equity shares, then it will be under section 112A. That is listed equity shares and equity oriented mutual fund. In that category it will go. And if it is listed and STT paid, 112A will be applied. So specified mutual fund means not more than 35% of its total proceeds is invested in equity shares of domestic company. So such a type of mutual fund, you should be assessee should acquire it on or after 1/4/2023. So if it is acquired prior to 1/4/2023, this section not applicable. Normal provisions of the IT Act. If it is long term, long term. If it is short term, short term. No deeming section. So acquisition must be after, investment must be after 1st April 2023. Second one is the MLD, market linked debentures. That is a debenture where the returns are based on market performance. That is market linked debentures. And further, certain debentures can be notified as MLD. Generally, if a debenture return is based on market, that is known as MLD, market linked debentures. There is no specific date is mentioned. So always the market linked debentures should be covered under this section. And third one, recent amendment, unlisted bond, unlisted debentures, which is transferred or redeemed or matured on or after 23rd July 2024. Remember, acquisition may be even prior to that date, but transfer on or after 23rd July 2024. These are the coverage. So only these three instruments are covered. From these three instruments, either transferred or redeemed or matured. At the time of maturity, capital gain arises. At the time of redemption, capital gain arises, or transfer, capital gain arises. Sale or redemption or maturity. Always the capital gain will be treated as short term. So you can claim expense for transfer, you can claim cost of acquisition, but no indexation. And always it is treated as short term capital gain. So the rate of tax applicable for short term capital gain will be applied, irrespective of the period of holding. Now regarding this specific mutual fund, we have to study further. If the mutual fund invested not more than 35% of its proceeds in equity shares of domestic company, it will be specified in mutual fund. Further, one more condition, acquired after 1/4/2023 as per 50AA. Okay, now if a specified mutual fund invested more than 65% of its total proceeds in equity shares, more than 35% but not more than 65%, between 35 and 65% is invested in equity shares of a domestic company, then they are saying it should be treated as a normal long-term capital gain and tax rate will be as per section 112. And if it is short-term, it will be treated as normal short-term capital gain. If it is transferred before 24 months, then short-term. After 24 months, it will be long-term. And if it is listed, more than 12 months or less than 12 months will be considered. So the condition, more than 35% but less than or equal to 65% invested in equity shares. And the next one, suppose if they are investing more than 65% of its proceeds in equity shares of domestic company, then it will be treated as a equity oriented units of mutual fund. And if it is listed, 112A, and if it is short term, 111A. 111A means special short term capital gain from listed equity shares and equity oriented funds where STT is paid, that is 111A. 112A means long term equity shares listed or equity oriented funds where STT is paid, so that is 112A. Sometimes a mutual fund will not directly invest its proceeds in equity shares. Instead of that, one fund will invest their fund in another mutual fund. Another mutual fund will invest in equity shares. So in that case, they are saying if funds are not directly making investment in equity share, instead of that, 90% or more of its total proceeds in other funds, and that other fund invests 90% or more in the equity shares of domestic company. In that case also, this mutual fund will be treated as 112A or 111A units. So this is the detailed provision of this specified mutual fund. And remember this amendment date. And further, one more amendment during the current year after 23rd July 2024, if unlisted bond or unlisted debentures is redeemed or matured or transferred, the capital gain will always be treated as short term, irrespective of the period of holding. And now we can go to that question. Mr. Sanjay is a resident in India, aged 55. He had an impressive investment portfolio in various mutual funds. He redeemed his entire mutual fund investment portfolio and bought a villa in Lonavala for ₹2 crore to spend the rest of his life there. The details of mutual funds are as under. BLR Growth Fund, date of investment 3rd April 2021. Date of redemption 5th June 2024. Current year redemption. Amount invested 120 lakhs. Amount redeemed is 140 lakhs. ABC Strategic, ABC Strategic Fund. Investment date 4th May 2024. Date of redemption 2nd February 25. Amount invested 46. Amount redeemed 50 lakhs. ABD Mid Cap Fund 2nd December acquisition. 5th July redemption 115-118. SBA Growth Fund 8th November 22 and 12th December 24 redemption. Okay. Now the details of the fund. Funds stated at 1 and 2 have invested 30% of their proceeds in equity shares of domestic companies. And fund stated at 3 and 4, ABD and SBA, 3 and 4, have invested 70% of their proceeds in equity shares of domestic companies. The investment pattern of funds remained unchanged over all the years. STT paid at the time of acquisition and redemption of mutual fund wherever applicable. You are required to compute the capital gain chargeable to tax in the hands of Mr. Sanjay for assessment year 25-26. And indexation details is also given. So we have to analyze whether for which items section 50AA will be applied. So first one, BLR Growth Fund, that is acquisition is 3rd April 2021 before the amendment date. So it is not covered here. So it will be not covered under 50AA. Normal provision. As per normal provision, we should see the holding period 3rd April 2021, 5th June 2024. So 22, 23, 24. It is more than 36 months. More than 36 months means long term. Long term. It is a normal long term capital asset. So we have to compute the capital gain as like that. With the indexation we can claim because it is before 23rd July 2024 transfer. So indexation is also possible. So we have to compute the capital gain. Full value of consideration 140. Plus indexed cost of acquisition 120, right? Divided by that is acquired in 2021-22. So 21-22 the indexation is 317, right? Into 363. What is indexed amount? 130 4 1. So what is the long term capital gain? 2.586, right? What's the name of this fund? That is BLR Growth Fund. Now the second one, ABC Strategic Fund, 4th May 2024. See, 4th May 2024 means after 1st April 23, right? It will be covered under section 50AA because they are saying the maximum invested is 30% in equity shares. And the date is also paka. So it will be covered under section 50AA. 50AA. We should mention the section 50AA. Yeah, they are saying not more than. It should be, investment should be less than 30. They invested maximum 30. The provision says maximum 35, right? Up to 35 is possible, not more than 30, right? So 50AA ABC Strategic Fund, full value of consideration is 50. Cost of acquisition, remember no indexation benefit is available. Always treated as short term, 46. 4 lakhs, right? Third one, ABD Mid Cap Fund. ABD Mid Cap Fund. So regarding ABD Mid Cap Fund, 2nd December 2023 and 5th July 2024. What is the investment pattern of ABD Mid Cap Fund? 70% of their proceeds in equity shares. So it is not covered in 50AA. Whether it is long term or short term. Normal provision, right? 50AA not applicable. But whether it is long term or short term. 2nd December 23. Transport on 5th July. It's short term. It's short term. Normal short term capital gain ABD Mid Cap Fund. Full value of consideration 118. Cost of acquisition 115. So 3 lakhs, right? And then SBA Growth Fund. SBA Growth Fund, 8th November 2022, 12/12/24. It is long term, right? Because it is 70% is invested means it is equity, right? And STT paid in all cases, right? So it will be treated as long term if the period of holding is more than 12 months, and it is listed. They invested 70% in listed. So 112A will be applicable, 112A. So section 112A. So full value of consideration 120. So here the acquisition is after 1st February 2018. If acquisition is after 1st February 2018, the special provisions of computation of 112 are not applicable. Straight away you can take the cost of acquisition. So cost is 110. In 112A, no indexation, right? 10 lakhs. So yeah. Third one is short term. 2nd December 23, right? 5th July 24, right? It's short term, right? Third one? Yeah, third one, it is short term, but 111A. Yeah, 111A because STT paid, right? Yes, 111A is possible. No indexation, right? Short term. Yeah, third one is 111A. That's correct. Because in all cases, STT is paid and 70%, right? 111A. And this is 112A. So we got the capital gain. Now there is a tax planning, right? Purchased a house property, right? Purchased a house property. So tax planning is possible. 54F. 54F is available from long-term capital asset. So from the first situation, it is possible. BLR, it is possible. And second one is short-term, not possible. Third one is short-term, not possible. Last one is possible. So cost of the new house property. What is the cost of the new house property? 2 crore, right? 2 crore. So 54F we have to try. So this NSC we can use. And this NSC also we can use. Total 2 crore, right? So which one we have to claim so that we will get the better benefit, right? Because 54F is proportionate to capital gain exemption, not directly. Capital gain into cost of the new house divided by NSC. So you see in BLR Growth Fund, first long-term capital gain, full value 140, cost is 137, capital gain is 2.586 only. When you see SBA Growth, the last one, 120 full value, 110 cost, capital gain is 10 lakhs. So it is better to first claim exemption against SBA because there the capital gain ratio is more. The first one, the ratio of capital gain compared to the total one will be less because 140, 137, only 2. Here 120, 110, 10 lakhs. So I am claiming exemption first from this particular capital gain here. F. So long term capital gain 10 lakhs into cost of the new house is 2 crore. Out of this 2 crore, I am claiming only 120 here. NSC 120 divided by 120. So I will get entire 10 lakhs as exemption. So this will become nil. So out of this 2 crore, 120 lakhs I claimed here. So balance available is how much? 80 lakhs. That I will claim here in the first one. So here 2.586 into numerator 80 lakhs divided by NSE 140. So what is the exemption here? $2.586 is the capital gain from BLR Group into cost of the new house. We can take only 80 lakhs because total 2 crore, 120 already allocated to SBA. So remaining 80 lakhs only we can take here. So 80 lakhs divided by NSE of BLR 140. So what is the exemption? 1.463. 1.4632 or 1.47, whatever may be. Okay, fine. So that's what's the remaining capital gain, taxable capital gain. 2.586 minus 1.4632. 1.11. Here the taxable long time capital gain. Here the short time capital gain 4 lakhs. And here the third one, short time capital gain triple 3 lakhs. And here nil. This is the total income of the assessee. 1.11 plus 1.11 plus 4 plus 3. It's the total income. If we claim 54F exemption first from BLR growth and then from SBA, definitely the final answer will be more. Capital gain will be more. To get better exemption, always claim the 54F from the capital gain, which has more ratio compared to the full value and cost of acquisition. If the capital gain is more, better to claim 54F exemption first from that capital gain. Remaining, if any, allocate to the other capital gains. So this is important, 50AA. Further, there is an amendment also because unlisted bonds and unlisted debentures is also covered. So that is from 23rd July onward. So that area is very, very important. 50AA is very important. And there is another area recently applicable for CF final only, that is 45 subsection 1B, 45 1B. That is in case of unit linked insurance plan. There is a special provision is there. That is also important, very important. So 45 1B, amount received under unit linked insurance plan. So it's a new section introduced around 2 years back, but never tested a major question from this area. And again, this is not applicable for Inder, only for final. 45 1B. So generally under the income tax law, life insurance policies maturity amount will be exempted under section 10 subsection 10D subject to certain conditions. The main condition is premium paid in a particular financial year should not exceed the prescribed limit. If the policy is taken prior to 1/4/2012, premium paid in a particular financial year should not exceed 20% of the sum assured in that policy. If the policy is taken on or after 1/4/2012, then the premiums paid should not exceed 10% of the sum assured. And if the policy is taken on or after 1/4/2013 and the person insured has a disability or specified disease, then the premium paid in a financial year should not exceed 15% of sum assured. So basically 3 ratio, 20% of sum assured, 10% of sum assured, 15% of sum assured. This is the limit of premium to claim exemption under section 10(10)(d) in respect of life insurance maturity, pure life insurance maturity. So if the question doesn't say regarding any policy date, assume recent all the policies will be covered under 10% category on or after 1/4/2012. We are in 2024-25, so 10%. So generally take the condition 10%. So if the premium paid in a particular financial year exceeds 10% of the sum assured amount, sum assured and maturity amount both are not the same. Maturity amount definitely will be more than sum assured. Sum assured means the guaranteed amount which will be shown in the policy document at the time of issue of policy itself. Maturity will be depending upon the market growth. Definitely maturity will be different. So they are saying if the premium paid in a particular financial year did not exceed 10% of sum assured, then the maturity amount will be exempted for life insurance. By utilizing this advantage, a lot of insurance company, they created some products that is known as ULIP, unit linked insurance plan, which is a combination of equity investment as well as insurance coverage. You will get insurance coverage as well as you will get a very good growth in investment. That is known as unit linked insurance plan. Why they created unit linked insurance plan? As there is a insurance content is there, they will get the exemption under section 10(10)(d). That is the reason why they created ULIP, and ULIP was a very big hit, right? Among the investors, it is a very attractive product because you will get a very good market growth, no need to pay capital gain, and the entire maturity will be exempted. You will get a very good growth. During that period, you will get a life insurance cover also. So it's very nice product. So high net worth individual or rich people started misutilizing this. They are taking unit linked insurance plan. They will pay premium of 50 lakhs and the sum assured will be 5 crore. So 5 crore into 10%, 50 lakhs. Does not exceed. So Sachin Tendulkar or Rajinikanth or Amitabh Bachchan, they will take this type of very big ULIP. They will make investment. They will claim exemption. No tax. So government put a condition. Okay, even though you satisfied, the premium payment should not exceed 10% of sum assured. We are putting one more condition in respect of ULIP issued on or after 1st February 2021. So those who taken unit linked insurance plan prior to this date won't be affected. They will still continue to claim exemption as far as that premium condition is satisfied. But in respect of ULIP issued on or after 1st February 2021, they have put the condition total premium should not exceed 2,50,000. So 2 conditions. Number 1, usual premium paid should not exceed 10% of sum assured, plus the premium amount paid in a financial year should not exceed 2,50,000. If you have multiple ULIP in each individual unit linked insurance plan, the premium may be less than 2,50,000. But if you take the combined ULIPs, it will be more than 2,50,000. Exemption will be denied. So 1,25,000, 1,25,000, 1,25,000. Total you have 3 ULIP, 125, 125, 125. Then any 2 ULIP you can claim exemption because 125 plus 125, 250. Or this 125, this 125, 250. Or this 125, this 125, these 2 policy, 250. Then this one will be taxed. Other 2 will be exempted. So which combination is best? We have to see in tax planning angle. We have to compute income from all these 3 ULIP, and higher 2 income ULIPs will be exempted, other will be taxable. So this is applicable only in respect of unit linked insurance plan issued on or after 1st February 21. That is very important because prior to 2021, even though premium is more than 2,50,000, you will get the exemption if that basic condition is satisfied. Premium should not exceed 10% of sum assured. But after this date, one more condition, 2,50,000 limit is put. Okay, if the premium exceeds 2,50,000, then what is the consequence? You are liable for capital gain. You are liable for capital gain. Capital gain should be computed as per 45(1)(b). How the capital gain will be computed? Take the maturity amount. That is amount received. Full value of consideration means the maturity amount received. Less cost of acquisition, total premium paid under that policy during the life of that policy. The total premium paid can be reduced. Remaining is the capital gain, and this capital gain will be taxable as per section 112A because it is a unit linked insurance plan. Basically, the investment is made in equity, so it will be taxable under 112A. Usually, majority of the ULIP are listed, and it is depends upon the market performance growth is given. So definitely 112A will be applied. So capital gain should be computed from the maturity amount, reduce total premium paid in that policy. One more condition they are putting, that premium paid should not be claimed as deduction in earlier years under 80C. If you claim deduction of that premium in earlier years, then that will not be eligible for further deduction as cost of acquisition. So this is the way capital gain should be computed. So remember, in respect of unit linked insurance plan issued on or after 1st February 2021, to claim exemption under section 10 subsection 10D, two conditions must be satisfied. Number one, premium paid should not exceed 10% of sum assured, and number two, the total premium paid in that policy should not exceed 2,50,000. If you have multiple unit linked insurance policies, in individual policies premium does not exceed 2,50,000, but when we take the total, sometimes it may cross 2,50,000. In that situation, those ULIPs which are coming under 2,50,000 can claim exemption, others will be taxable. Purely choice of assessee, most beneficial option of assessee can be selected. So in case multiple ULIPs, amount received from only those policies whose aggregate premium less than or equal to 2,50,000 exempt. Remaining policies taxable. Beneficial way we have to select. So this is a theory of section 45 1B. Similar exemption available in respect of life insurance policy. But regarding life insurance policy, ULIP and life insurance policy is different. ULIP, there is an investment in equity also. Life insurance policy, that may not be investment in equity, that is purely a life insurance. Definitely you will get a return, you will get a maturity. That is governed under section 56, income from other source. In respect of life insurance policies, if the premium paid should not exceed 10% of sum assured plus total premium should not exceed 5 lakh, double of 2,50,000, 5 lakhs, then maturity will be exempt under section 1010D. If the life insurance policy's premium exceeds 5 lakh, then it will be taxable under IFOS, like normal income. Computation same, maturity of the life insurance policy, reduce total premium, balance income taxable under income from other source. But if it is ULIP, 2,50,000, income taxable under capital gain, 112A. Normal life insurance policy, IFOS, limit is 5 lakhs. But whether life insurance policy or ULIP, exemption 1010D, basic condition common, premium paid should not exceed 20% or 15% or 10% of sum assured. At present, the limit is 10%. Got the idea? We can go to question. Further, one more thing, if the life insurance maturity is taxable, life insurance company has to deduct TDS. If the maturity amount is 1 lakh or more, life insurance company shall deduct TDS at the time of giving maturity. TDS rate is 5%, section 194 DA. And this 5% TDS is calculated on, not on maturity amount, on income element. On income element. That is maturity minus total premium paid, remaining is the income. On that income, 5% TDS, 194 DA. So now you should take that next question. Manoj, age 45 years, is a resident Indian who has the following life insurance policies, some of which are ULIP. Okay, here we are discussing the portion of ULIP. The details of such policies are given here under. Date of issue, A and B is actually life insurance policies, purely life insurance, because they are not saying ULIP. All others are unity linked insurance plans, C, D, E, F. Date of issue, A 1/4/2017, B 1/4/2018. ULIP, first one is 1st February 2021, second one 1st January 21, E ULIP 1st March 21, next one is 1st April 2021. See, the policy D, unity linked insurance plan D, not covered under the amendment. Why? Not covered under the amendment. Why? Because the issue date is prior to 1st February 2021, right? So D, unity linked insurance plan, they can claim exemption if the premium does not exceed 10% of sum assured. What is the premium of D ULIP 3 lakh? What is the sum assured? 30 lakh. 30 lakh into 10%, 3 lakh. So it does not exceed 3 lakh. So straight away we can say D unity linked insurance plan will not be considered for the purpose of 2,50,000 limit. Anyway, it is unconditionally exempted. D exempted. Now C is there, E is there, F is there. So all those three are covered under the new amendment. So annual premium is given, date when premium falls every year, and date of maturity, and maturity amount is given, and the sum assured is also given. During the previous year 24-25, Mr. Manoj has earned dividend income. Okay, he has income from other source 12 lakhs, and income from shares of Indian companies, and long-term capital gain computed 5 lakh, transfer before 23rd July 24. He deposited 1,50,000 in National Pension Scheme Tier 1 account of government, that is section 80 CCD, chapter 6A. Manoj opt out from 115 BSE default tax regime. Okay. First question, what are the life insurance policies including ULIPs in respect of which Mr. Manoj would be eligible for exemption under section 1010D? They are asking only regarding ULIP. So don't consider life insurance. They are asking only regarding ULIP. So C, D, E, F only should be considered for first MCQ, in respect of which Mr. Manoj will be eligible for exemption in respect of maturity process, and what is the amount of deduction which would be available under section 80C in respect of premium paid on such policies for assessment date 25-26. Assume that Mr. Manoj does not have any unity linked insurance plans, only for the purpose of answering this MCQ. Okay, here we can straight away say policy, they're asking regarding only regarding life insurance policies, right? Excluding ULP, right? So they're asking only regarding A and B. A and B. Okay, A and B. Out of A and B, which one will be exempted? Don't consider ULIP. And what is the total chapter 6 reduction under section 80C regarding premium? Okay, we can see life insurance policy A. Annual premium 50,000. Sum assured is 6 lakh. 6 lakhs into 10%, 60,000. So the premium is within the limit of 10%. Policy A will be exempted, right? And B, sum assured is 3,50,000, but the premium paid is 40,000, which exceeds 10% of sum assured. Policy B will be taxable. Policy B will be taxable. A will be exempted. And what is the deduction available? Deduction available is policy A, premium is 50,000, 80C eligible. Policy B, entire 40,000 we cannot claim, because under section 80C, if the premium exceeds the limit, it should be restricted to the limit. So only 35,000 is eligible. So 35,000 plus 50,000, 85,000 is chapter 6 80C. And policy A will be exempted. Which is the best answer? Option? Option? Policy A will be exempt. Okay. Total deduction available under 80C is 50,000 plus 40 not available, because 3,50,000 into 10% is the maximum deduction available under 80C. So 35,000. So 50 plus 35,000 would be 85,000 is the 80C deduction. And this policy is exempt. This is taxable because the premium bid exceeds 10% of sum assured. So 80C is 85 and policy A would be exempted. So which is the correct answer? D, right? D. D is the correct answer. Only A, and 85,000 is the deduction under 80C. And second question. What are the unity linked insurance plans in respect of which Mr. Manoj would be eligible for exemption under section 10 subsection 10D in respect of maturity proceeds? Choose the option most beneficial to Mr. Manoj. In respect of ULIP, okay, what is it, which are eligible for exemption? So in respect of ULIP, first of all, we can say that D insurance ULIP, this is anyway exempted because it is prior to the amendment. Basic condition is satisfied. 30 lakh into 10%, 3 lakh. So this one will be anyway exempt. Now we have three policies, C, E, F, 3 ULIP. Okay, C, E, F. What is the premium of C? 1 lakh. 10% condition satisfied. E, 15 lakh into 10%, 1,50,000. 10% condition satisfied. 25 lakh into 10%, 2,50,000, that is also satisfied. But the problem is 1 lakh plus 1 lakh 40 will be 2 lakh 40. But if you take this 2 lakh 50, it will be more than 2 lakh 50. So maximum policies where the total premium does not exceed 2 lakh 50 eligible for exemption. So we have to find out the income in all the policy so that we can choose a best option. So first one, 10 lakhs is the sum assured. Maturity is 11 lakhs. So if maturity is 11 lakh minus total premium paid. So 2021 1st February is the first premium and maturity is 2030. So 21, 22, 23, 24, 25, 26, 27, 28, 29. 9 years he will pay the premium. So 1 lakh into 9. So total premium paid will be 9 lakhs. If 9 lakhs reduced from 11 lakhs, we will get the income. What is the income? 2 lakhs capital gain. Policy D anyway exempted, so no need to make this computation. Policy E, ULIP, 1 lakh 40. Again, that is also same. 9 years they will pay the premium. 1 lakh 40 into 9. What is the amount? 12 lakh 60,000. So what is income? 4 lakh 40,000. So here also 2 lakh 50,000 in 9. What is the total premium paid? 22 lakh 50,000 minus 28 lakh. What is income? What is income? 5 lakh 50. Here the highest income is for ULIP F, but the premium of ULIP F itself is 2 lakh 50. So if that is taken, will be a loss for the assessee because other two income will be 2 lakh and 4 lakh 40. There will be 6 lakh 6 lakh 40,000 will be income. So these two, C and E, if we take together, 1 lakh plus 1 lakh 40, total premium 2 lakh 40, which in 2 lakh 50, and we will get an exemption of 2 lakh and 4 lakh 40. 6 lakh 60,000 can be, 6 lakh 40,000 can be claimed as exemption. So that is better. So claim exemption for C and E, and F ULP will be taxable. D also we can claim exemption anyway. F ULP will be taxable. That is the best option for assessee. Okay. Our answer is he can claim exemption for C, D and E. Only C and D, only F, C, D and E. So which is the best option? Option C. C, D and E is the best option. Considering the option chosen in MCQ 8 to above, just above, right? 2 above. Okay, MCQ 2 above. What would be the capital gain computed under section 45(1)(b) in the hands of Mr. Manoj for assessment year 3031? Assume that for the purpose of this MCQ, no consideration was received prior to the maturity date in case of any ULIP. Yeah, the taxable amount we can take, right? 5 lakh 50, right? 5 lakh 50. What is Mr. Manoj's tax liability for assessment year 25-26? That we have to compute. Make the computation, right? The income given in the question is there is a dividend and long-term capital gain also. So first I will take long-term capital gain, 5 lakhs. Then dividend, 12 lakhs. Then you should see policy B. Policy B will be taxable, and policy B matured on 31st March 2025 in our current year. Policy A is also maturing on 31st March 25, but that is exempted. But policy B is taxable. So we have to take the income from policy B under IFOS. So maturity 4 lakh. What will be the total premium paid by that person? For 40,000, 1/4/2018. So 18, 19, 20, 21, 22, 23, 24, 24. He will pay premium for 7 years. So 7 into 40,000. Maturity 4 lakh. Less premium paid 40,000 into 7. 7 years. 2 lakh 80,000. So what is the income? 1 lakh 20, right? Yeah. Yeah, there are a lot of other ULIPs there, right? Yeah, see, we can say we didn't claim for policy A in prior years. We are taking that assumption. Okay. Or we can say that there is other ULIPs there, right? That is taken 2021, 21, 21. For all those, we can claim chapter 6, we can take that view also. Or he can claim chapter 6 in respect of other principal repayment, all other chapter 6 available. So take the best, that assumption, right? Because question is not clear. GTI 18 lakh 20 less chapter 6A 80C. There is a lot of ULIP and even insurance policy A for which he can claim premium straight away. Simply he can claim 1 lakh 50 because ULIP life insurance premium is also eligible for 80C. So maximum limit he can claim 1 lakh 50. Now they are saying he deposited 1 lakh 50,000 in NPS. 80 CCD subsection 1. If a person is a self-employed person, 80 CCD 1B, actually 80 CCD 1B and 80 CCD 1. There are two sections available for self-employed person to claim contribution in NPS. As per section 80 CCD 1B, straight away they can claim 50,000 deduction. But as per section 80 CCD 1, they can claim deduction up to 20% of their GTI. Up to 20% of their gross total income they can claim if it is a self-employed person. If it is a salaried person, he can claim up to 10% of his gross total income, or in some cases 14% of GTI. But for a self-employed person, he can claim up to 20% of the GTI. But as per section 80 CCE, total deduction under section 80C plus CCC plus CCD subsection 1 should not exceed 1 lakh 50,000. Here already his limit of 1 lakh 50 reached in 80C. And further under 80 CCE limit, 80 CCD subsection 1B is not covered. And even 80 CCD 2 employer's contribution also not covered. So this 80 CCD 1B he can claim, but CCD 1 he cannot claim because the limit is reached. So balance is the total income. So what is the total income? $5,50,000? No, that 5,50,000 arise when 2020, 2030, 2029, 2030, 2030. That will happen only in 2030, right? They are asking for current year, 24, 25. What is the total income? Total income 18 lakh. No. 18 lakh 20 minus 1 lakh 50 minus 50. 16 lakh. On this 16 lakh 20,000, we have to compute the tax. Out of this flat rate, long term capital gain 5 lakhs, we have to reduce. 5 lakhs, flat rate 20. Here the transfer is happened before 23rd July. So flat rate 20%. Old rate must be taken 20%. That will be 1 lakh, right? $16 lakh 20, reducing capital gain, remaining is the slab rate normal income. 16 lakh 20 minus 5 lakh, 11 lakh 20. 11 lakh 20, we have to take the slab rate. Up to 10 lakhs, the tax will be 1,12,500 plus balance 1,20,000 30%, which will be 36,000, right? Yeah, okay. So 1,12,500 plus this capital gain tax 1 lakh plus 1,12,500 plus 36,000. What's the total tax? What? 248 tax, right? Cess. Double 940. So tax liability 258. Which option? C. Now the last question in that MCQ. What would be the total tax deductible under section 194DA during the previous year 24-25 on payment of maturity proceeds of life insurance policies to Mr. Manoj? As we are aware, only one policy is taxable, that is policy B. So policy B, if the maturity amount is 1 lakh or more, TDS is applicable under 194DA. TDS is calculated on income element in the policy. But whether to attract a TDS or not, the threshold limit is maturity. Maturity should be 1 lakh or more. But TDS rate is 5% applied on income. So here the life insurance policy income we already calculated. What is the income? 1 lakh 20. So this 1 lakh 20 into 5% is the TDS. 5% TDS under section 194DA. The maturity amount is 4 lakh, which is more than 1 lakh. So TDS is applicable. But TDS should be computed not on maturity proceeds. It should be computed on income element in the policy. Here the income element in the policy is only 1 lakh 20. So 1 lakh 20 into 5% is the TDS under section 194DA. To the firm at the time of admission or maybe otherwise. So maybe at the time of admission or at a later point of time, or instead of giving capital, he is giving his capital asset. Instead of giving money, capital contribution, he is giving some capital assets, or sometimes for the goodwill, he may transfer his capital asset. So whatever may be. So what is the value recorded in the books of the firm, or we can say book value, or value recorded in the books of the firm for that capital asset is the full value of consideration of partner. From that, partner can reduce the cost of acquisition. There will be capital gain for the partner. That is 45 subsection 3. Not that much important. Transfer by partner to the firm. Not important. So the most important area is by firm or LLP to the partner. So first section. Yeah, okay. So when a partnership firm or limited liability partnership firm or LLP or even AOP or BOI, association of person or body of individual, transferred the capital asset or stock in trade to the partner or to the member. In respect of AOP and BOI, we will say it as member. Firm and LLP, we will say partner. So transfer of capital asset or stock in trade by the firm or LLP or AOP or BOI to the partner or member at the time of dissolution or admission or retirement or death, etc. So everything will be covered. So change in reconstitution of a firm, that's a word used. The change in reconstitution further defined dissolution, retirement, admission, or even change in existing profit sharing ratio if any capital asset is transferred to the partner by the firm or LLP. Section 9B arises. 9B. So after 9B, we will go to 45 subsection 4. So as per section 9B, at the time of dissolution or retirement or admission or change in profit sharing ratio or change in any share, if the capital asset is distributed or stock is distributed by the firm or LLP or AOP to the partner, capital gain as well as PGBP, if it is stock in trade, PGBP, if it is capital asset, capital gain, arises to the firm or LLP, AOP, BOI as per 9B. So how that will be calculated? Very simple calculation. If capital asset is distributed to the partner or stock is distributed to the partner, capital asset is distributed to the partner, then find out the fair market value of that capital asset on the date of distribution. that should be treated as the full value of consideration of the firm. And if it is stock in trade, take the fair market value of that stock in trade in the hands of the firm as the sales value, reduce expense for transfer if any in case of capital gain. In case of PGBP, reduce the cost. In respect of capital asset, reduce the cost of acquisition, or if the transfer is before 23rd July 2024, indexed cost. Otherwise, cost of acquisition we can reduce. We will get the capital gain or PGBP income of the firm under section 9B. It is taxable in the hands of the firm or LLP or AOP or BOI. Now there is no impact for the partner, impact for the firm. 9B. So 9B applicable when the assets are distributed at the time of dissolution. In settlement of capital dues of the partner, asset may be distributed, or retirement to settle his capital, they may distribute assets, or at the time of admission, the existing partners will be compensated with some assets given by the new partner, or change in profit sharing ratio. If as we are aware, some case of retirement, etc., there will be some sacrificing ratio, admission sacrificing ratio, some gaining ratio. So to settle all those things, sometimes asset will be distributed to the partner. So if capital asset is distributed by the firm to the partner, or stock is distributed by the firm to the partner as part of any settlement related to dissolution or retirement or admission or change in share, this section will applicable, 9B. And capital gain or PGP income arises to the firm. This is the first part. So whenever there is 9B, there is a possibility of section 45 subsection 4 except dissolution. At the time of dissolution, if asset is distributed, only 9B arises, 45 subsection 4 not applicable. 45 subsection 4 applicable only when there is a retirement or admission or any other change in sharing ratios, something like that. As part of settlement, some assets is distributed to the partner by the firm, 45 subsection 4 may arise. Especially capital settlement, 45.4 will arise. But if the capital is settled at the time of dissolution, only 9B, there is no 45.4. So that's a basic difference between 9B and 45.4 regarding situation, coverage. 9B covers all situations, that is dissolution, retirement, admission, change in share, covered under the definition of reconstitution. But in 45.4, change in reconstitution contains only retirement, admission, change in share. So what is section 45 subsection 4 says? See, from the side of partner, if we think he is getting some assets. So why he is getting some assets? Sometimes he will get some money. So because to settle his capital balance. So if the partner is received anything in extra over and above his capital balance, there is a gain for the partner. Actually, that gain should be taxed in the hands of the partner. But they created the provision, no, such a gain is not taxable in the hands of the partner. It will be taxable in the hands of the firm. So at the time of dissolution, 9B will arise, but 45.4 does not arise. But retirement, if the partners are settled, 9B and 45 subsection 4 simultaneously will apply. So first we should make the calculation of 9B. Only if 9B computed, then only we can proceed to 45.4. Without completing 9B, we cannot compute 45.4. So what 45.4 says? That says that what is the fair market value of capital asset received by the partner from the firm plus what is the money received by the partner from the firm. We should take the total. Fair market value of capital asset received plus money received by the partner from the firm at the time of retirement or a change in share, etc. should be taken. From this, reduce the adjusted capital of the partner. So if we reduce adjusted capital of the partner, and if balance there is a positive figure, that means partner is getting extra. His capital balance, adjusted capital balance is 50 lakhs, but he is getting fair market value of asset plus money is 60 lakhs. So the amount to be settled is 50, but he is actually getting 60. That 10 lakhs is the gain earned by partner, but that gain is not taxable in the hands of the partner. That is also taxable in the hands of the firm as per 45 subsection 4. So there is a double taxation, but to eliminate the double taxation, they are saying further whatever capital gain tax they are paid, it will be again allowed as a cost to the firm. So in that way, that will be reduced, that eliminating the double taxation. So that we will discuss in problem. So understand the concept. If partner is getting anything extra in addition to his capital balance, adjusted capital balance, that extra is an income taxable under section 45 subsection 4 as capital gain only. So under section 45 subsection 4, stock in trade is not covered. Stock in trade is not covered. Only fair market value of capital asset received by the partner from the firm plus money received. Less adjusted capital balance. That remaining, if it is positive, that is capital gain under section 45.4. And this capital gain under section 45 subsection 4, whether it is long term or short term, depends upon the remaining capital assets held by partners, that partnership firm. So the 45 subsection 4 is not applicable for dissolution, right? So there will be retirement or admission, something like that. So partners are settled. In that situation, definitely remaining partners are continued with the firm. So definitely there will be a lot of other assets remaining in the balance sheet of the firm at the time of this 45 subsection 4 taxability. So this particular capital gain will be decided whether it is long term or short term depending upon the remaining capital assets available with the firm. So if the remaining capital assets available with the firm is long term, then this capital gain will be long term. If all the remaining capital assets contains long term as well as short term, then this capital gain should be apportioned towards long term as well as short term. So what ratio we will be used? The ratio of allocation between long term and short term depends upon whether there is any revaluation happened at that time. So if for the remaining assets, if there is any revaluation made, based on that revaluation ratio, this capital gain should be allocated towards long term or short term. So at the time of retirement or admission, etc., definitely the partners' balance sheets or assets will be revalued. At that time, there may be a possibility of valuation of self-generated goodwill. So if there is self-generated goodwill in the balance sheet at this particular time, then that self-generated goodwill, to the extent of that self-generated goodwill, allocation will be treated as short term. If there is depreciable asset in the balance sheet, that will also be treated as short term. So if the remaining asset is land, depreciable asset, self-generated goodwill, then land long term, and this is short term, depreciable asset, self-generated short term. So long term, short term, short term. This capital gain will be splitted. So what is the ratio? The ratio is not the asset ratio. The ratio is to the extent of revaluation. The remaining land original cost is 10 lakh, revalued to 20 lakhs. So 10 to 20, the revaluation is 10 lakhs. Depreciable asset revalued 10 to 15. So the revaluation that figure is 5 lakhs. Self-generated goodwill is 8 lakhs. Valued in now only. Self-generated 8 lakh. So this is the ratio. So this revaluation is the ratio. Based on that ratio, this capital gain will be splitted towards land long term, towards self-generated goodwill short term, and towards depreciable asset short term. So this is the way 45 subsection 4 capital gain is allocated. See, only after this allocation we can say whether this capital gain under 45.4 is long term or short term. Sir, what about 9B? 9B, there is nothing to do with the remaining assets. Which assets are distributed? If that asset is long term, long term. If it is stock, PGBP. If that transferred capital asset as settlement is short term, the capital gain is short term. But 45.4, the capital gain is long term or short term depends upon remaining assets. So this is the theory. And some other points you have to keep in mind is if capital asset or stock is transferred by the firm to the partner, first we shall make the computation under section 9B, and then net book profit after tax shall be adjusted in the capital accounts of all the partners. If a capital asset is distributed to a partner, definitely all the other partners will say the book value of that asset is not the fair market value. So there is a difference that we are eligible to get the share from that. So definitely there will be a revaluation of that asset distributed to partner. On that revaluation, all other partners will get the share. But towards this capital gain, the firm has to pay income tax. If there is stock is distributed, the firm has to pay PGP tax. So that tax will be reduced from the revalued figure of the asset distributed to partner. Remaining will be distributed towards the partners, all other partners to the capital. In that way, we are computing the adjusted capital balance. I will explain in a problem. That adjusted capital should be compared with the fair market value of capital asset received plus money received by the partner. If there is a gain, that is 45.4. Sometimes the capital balance will be 50 lakhs, but fair market value of asset received plus money received by the partner is only 45 lakhs. But his capital balance is 50. There is no 45 subsection 4. There is a loss. That loss not allowed to the firm. Nothing, zero. And 45 subsection 4 not applicable for dissolution. The above capital gain, that is capital gain computed under section 45 subsection 4, will be short-term capital gain if the remaining assets are short-term, or remaining assets are depreciable asset, or remaining asset is self-generated goodwill valued. or any other self-generated asset valued based on registered valuer. But if some of the remaining assets are short-term or depreciable asset or self-generated asset and some are long-term, then we have to make the allocation. At that time, we need the ratio. Then the above capital gain will be partly short-term and partly long-term to be apportioned in the ratio of appreciation or revaluation of the remaining assets, including self-generated goodwill. The amount of capital gain tax under section 45(4) will be reduced from. So this capital gain, firm is paying the tax for this 45 subsection 4 capital gain. So this amount of capital gain can be claimed as a cost of acquisition in future. In future, when that remaining assets are transferred, from the full value of consideration of that remaining assets, if it is sold in future, from that we can reduce this particular allocated capital gain amount from the full value of consideration, just like that of expense for transfer. They are not permitting to add to cost of acquisition. They are not permitting this amount to claim depreciation, but they are saying this amount of capital gain tax paid by the firm under 45 subsection 4 will be permitted to reduce from the full value of consideration of that remaining assets if that is transferred in future. Otherwise, no immediate benefit for the firm, even though they are paying double tax. So this is a theory. Now we will try a problem so that you will get a clear picture. So there is a detailed question is there. You have to take that question. Question number 19. Okay, Mr. Prem is a partner in two firms, XN Company and YN Company. So there are two partnership firm, XN Company and YN Company. In both the firm, Mr. Prem is a partner. So XN Company has 4 partners, including Prem, who share profits and losses equally. That is regarding XN Company. So Prem resigned from XN Company on 1/4/2024. Remember, retirement. In case of retirement, there will be 2 events, 9B and 45(4). Both are for the firm. On the said date, the capital balance of each of the partners stood at rupees 32 lakhs. In order to settle the dues of Mr. Prem, the firm revalues its land for the first time since purchase. The valuer also valued self-generated goodwill at rupees 70 lakhs for the first time. The firm has the following capital assets whose details are as follows. Particulars of assets: land at Pune, land at Nagpur, land at Mumbai, self-generated goodwill, now valued 70 lakhs. Date of purchase: Pune 2013, definitely long term. Nagpur 15, long term. Mumbai 13, long term. So clearly we can say that if land is transferred to the partner, capital gain under section 9B will be long term, because asset is long term. 9B. But 45(4) we can't say long term, depends upon remaining assets. Cost of acquisition, that is only book value, 15 lakhs, 25.4, 88. Now all these assets has been revalued. So 15 lakhs land is revalued to 50, 25.4 revalued to 45, 88 revalued to 250, and self-generated goodwill valued now 70. Okay. So this is as per the valuation report. So please correct the date 1/4/2024. Value as on 1/4/2024. Yeah. Now we are continuing the question. In April 2024, XN Company gave a land at Nagpur and rupees 15 lakh money to Mr. Prem to settle his capital balance. Okay. This is the details regarding the first firm. Remember, first firm only retirement, no dissolution, and partner is settled. So definitely in the first case, there will be 9B and 45 subsection 4. You will do the question later. First read the question, right? Second, next firm. The firm YN Company dissolved on 1st March 2025 and distributed its land at Chandigarh, Mohali and Gurgaon. Remember, dissolution. In case of dissolution, only section 9B. There will be no 45(4). No 45(4). 3 partners, Prem, Akshay and Arav. They are also equal partner. Particulars of these lands are given here under. So only we have to compute 9B only. Land at Chandigarh, land at Mohali, land at Gurgaon. In addition, Prem and Akshay were given money of rupees 8 lakh and 11 lakh respectively on 1st March 2025. Cost inflation index is also given. So what's the question? First question, what would be the amount of taxable under section 9B in the hands of XN company and YN company for assessment year 25-26? Okay. So first we are going to find out the 9B capital gain of XN company. Okay. First we will do XN company. So XN company partnership firm, they distributed the land to Mr. Prem. Which land is distributed to Prem? Land at Nagpur. So this is the item for capital gain. Here capital gain under section 9B. So what is the full value of consideration? 45 lakhs. Correct? 45 lakhs. Full value of consideration 45 lakhs. Less in-text cost of acquisition. Remember 1/4/2024. So prior to the date of amendment, prior to 23rd July, we can claim indexation. So this is the original cost 25.4. So that we have to take the indexation for 15-16. 25.41 divided by 25.41 divided by 2015-16. In the question given, 2015-16 indexation, how much? 254 into 363. Yeah. What is indexed cost? 36.3. 36.3. So long-term capital gain under section 9B of XN company firm. We'll get the answer. What is that? 8.70. So XN companies capital gain under section 9B 8.70. 8.70. $8.70, right? XN company. And now regarding YN company. So we'll see the YN company. So YN company is actually distributing their assets to two partners. Okay. So there will be two capital gain because two assets is distributed. So sharing profit loss, the particulars of this land are given under and the next part they are saying, in addition, Prem and Akshay were given money 8 lakhs and 11 lakhs. So there is a money they received. So what are the assets given? That's given here. Land at Chandigarh, Mohali and Gurgaon on the same day to its three partners. Okay, all these three assets has been transferred, right? Prem, Akshay and Arav. So for all these three, so we have to compute the capital gain. Simply compute the capital gain here only, right? Because remember the date 1st March 25 after the amendment date. So it's easy. Now need to find out the indexation. Indexation not available. Indexation not available. Simply compute the capital gain. Simply take the difference. Under section 9B. Land at Chandigarh. All are long-term capital gain. First one, 18.4, 62 minus 18.4, 30, 40, 3.6. Second one, 43.76. Next one, 53.3, right? So this is the capital gain for YN company, company partnership firm under section 9B. So the first part is over. Second, what would be the capital gain taxable under section 45(4) in the hands of XN company? That we will do. You read the third question. What would be the capital gain taxable under section 45(4) in the hands of YN company? What's the answer? Nil. Because section 45(4) not applicable in case of dissolution. So we should do the 45 subsection for capital gain in the hands of X and company. So regarding X and company, I will explain. The first issue is, in the books of accounts of the partnership firm, the book value of asset is 25.4. And this 25.4 has been revalued to, this 25.4 revalued to 45. So definitely all the remaining partners will ask for the share, because this asset is appreciated over the period of time when they are also partners in the firm. So in the books of accounts, what they will do is, fair market value of the asset 45, which is distributed to the partner only 45. And what is the book value? 25.4. So what is the appreciation? 19 point. All the partners will ask for share from this 19.6. But firm cannot distribute this entire 19.6 revaluation share to all the partners, because firm has to pay tax now. So regarding the asset distributed to partner Mr. Prem, a firm is liable for capital gain under section 9B of rupees 8.7 lakhs. So for this 8.7 lakhs under 9B, the firm has to pay tax. This is long-term capital gain, not 9.7, 8.7, right? So for 8.7, firm has to pay tax. This is before amendment, 20% plus 4% cess. So compute the capital gain liability of the partner, actual tax liability of the firm on 8.7 long-term capital gain. 8.7 into 20% tax and 4% cess. Tax on capital gain 1.81. Because firm can distribute only after all the expense is met. So this is an expense for outflow for the firm. So as per books, the gain is 19.6. But as per income tax, the gain is 8.7. So for that 8.7, firm has to pay tax at the 20% plus 4%. But in books, there is an adjustment. There is a revalue. So revaluation share will be asked by the remaining partners because asset is going out. So 19.6. But they cannot distribute entire amount. From that, reduce the tax to be paid by the firm, 1.81. Remaining, they will distribute. What is the remaining amount? 19.6 minus 1.81. 17.79. This will be eligible for all the three partners. 3 or 4? In X1 company, what are the number of partners? 4. 4, right? Equally, right? Should be distributed equally. 1/4, 1/4, 1/4, 1/4. Including Prem. We need to find out the adjusted capital of Prem. But for that, we need the complete share. So what is 1.4? 4.45, right? 4.45. 4.45. 4.45. So Prem will get 4.45 also from this particular share. So now we can find out the adjusted capital. So whether the question gives the capital balance? 30. Add this particular share, 4.45. So what is the adjusted capital of the partner? 36.45. So actually partner should be settled for this 36.45. That's a concept. So to settle this 36.45, what are the assets he is getting? He is getting a land and also money. Land fair market value 40 lakhs. Less. He is getting land 45 and he is getting money. Money how much he is getting? How much getting? 15 lakhs. So what is total? 45 plus 15. 60. He is getting 60. So definitely there is an appreciation. 36.45 is less than 60. So he is getting more. So 60 minus 36.45. What is the amount? 23.5 23.55. This 23.55 is the capital gain under section 45, subsection 4. Now the issue is allocation. It is capital gain. Now we have to say whether long term or whether short term, and what is the future treatment of this 23.55 in the hands of the firm. So that we have to discuss. So what is the next question they are asking? So capital gain 45.4. Fourth question, what would be the amount apportioned to land at Pune and land at Mumbai? So land at Pune, here land at Pune and land at Mumbai, how the amount will be allocated, which to be reduced from full value of consideration for computing capital gain of such asset when sold at a future date. Next question also connected. If self-generated goodwill is sold in previous year 25-26 for 80 lakhs, what would be the capital gain on such a sale in the assessment in 26-27? This 23.55 lakhs capital gain under section 45.4 to be allocated over the remaining assets based on the revaluation ratio. So land at Pune, original cost 15. So what is the revaluation ratio? So find out the revaluation ratio. So here the revaluation ratio 15 to 50. What is appreciation? What is appreciation? 35 lakhs. Okay. Now land at Mumbai. Nagpur is gone. So land at Mumbai 88 to 250. What is the ratio? 162. And what is self-generated goodwill amount? 70. So this 45 subsection 4 capital gain computed, that is amount 23.55 should be allocated in the ratio of 35 is to 162 is to 70. 35 proportion long term Pune attributable to Pune. Mumbai long term attributable to Pune. Self-generated goodwill 70 attributable amount short term. 55 into 35 divided by 35 plus 162 plus 70. Similarly, next one 23.55 into 162 divided by 35 plus 162 plus 70. Self-generated goodwill 23.55 into 70 divided by 35 plus 162 plus 70. We'll get the answer for that. What will be the capital gain attributable to Pune and Mumbai? Pune 3.09. 14.29 for Mumbai, right? And what is for self-generated goodwill? 6.17. Total will be that amount, right? 23 point something. This 3.09 and this 14.29 and this 6.17. Simply they can show us the capital gain tax paid by the firm. On this particular capital gain, the firm paid a tax, but they will get the benefit of this 3.09 and 14.29 and 6.17 only in future. In future, when they transferring this land at Pune by the firm, while computing the capital gain of land at Pune, what is the actual sale price, full value of consideration? From that amount, less 3.09, which is earlier, the capital gain tax under section 45 subsection 4 attributable to this land. So this 3.09 they can reduce only in future. At the time of transferring that particular land, they can claim it as just as a cost of acquisition, or we can say expense for transfer, whatever may be. Anyway, it will be reduced directly from full value of consideration, just like expense for transfer. And similarly, Mumbai land, if they are selling that land at Mumbai in future, at the time of computing capital gain from the full value of consideration of land at Mumbai, they can reduce 14.29 from the full value of consideration. And regarding the self-generated goodwill, if they sold in future 2025-26, they are given the figure itself. So 25-26, full value of consideration 80 lakhs less cost under section 45 subsection 4 earlier taxed 6.17. So what is NSE? 80 minus 6.17. 73.883. Under the income tax law, as per section 55, cost of acquisition of self-generated goodwill is always taken as nil. So this will be the long-term capital gain if they transfer this self-generated goodwill for 80 lakhs in 25-26. This will be the capital gain. So immediately they won't get any benefit on the double taxation of the capital gain under section 45 subsection 4, but they will get the benefit only in future. So this is 45(4) and 9(b) for a partnership firm. Remember for self-generated goodwill, this capital gain 6.17 in the current year, this 6.17 in the current year will be treated as short-term capital gain under section 45(4). This will be treated as long-term capital gain under 45(4). This will be also treated as long-term capital gain under section 45(4). So even though we are saying 23 point something full capital gain, but it should be allocated long-term, short-term. Again, this capital gain in future can be reduced from full value of consideration of the corresponding allocated assets. Until then, you won't get any benefit. And if this amount is attributable to depreciable asset, you can't claim depreciation. So this is 45(4) and 9(b). Clear? It's very important. You have a doubt? No. It's very important. They asked only once. A big question they asked for 6 marks only once. After this section is introduced. So this is 45(4) and 9(b). 9(b) and 45(4). Now we can go to the next area, that is slum sale. Actually, it is an easy area, slum sale. If a running business undertaking is transferred for a lump sum consideration without value being assigned for individual assets and liabilities, we can call it as a slum sale. Sometimes an entire business undertaking may not be transferred. Only a part of a business undertaking, that is an individual independent unit or independent division or independent department, may be transferred for a lump sum consideration. There also, without individual value has been, assets has been not separately valued. For a lump sum consideration along with assets and liabilities, a running business undertaking is transferred. We can call it as a slum sale. Similarly, under business restructuring area, there is a provision, amalgamation, demerger, etc. Under the income tax law, amalgamation, at the time of amalgamation, if capital asset is transferred, it is not a transfer as per section 47. Similarly, under demerger, if a capital asset is transferred in a scheme of demerger, restructuring, it is not a transfer as per 47 and no capital gain liability arises. But there is a very strict condition. Amalgamation should satisfy the definition criteria of amalgamation. Demerger should satisfy the definition criteria of demerger. Amalgamation defined under section 2 subsection 1b. Demerger defined under section 2 subsection 19AA. In these two sections, they are clearly mentioning certain condition. All the assets and liabilities of the old company should be transferred to the new company. It should be carried out at book value. And the purchase consideration should be received only by way of shares. And the shareholders holding at least 75% shares of the old company shall become shareholders in the new company. So there are a lot of conditions. Demerger, further there is some additional conditions. It should satisfy the Companies Act provisions also. And there should be approval of the court. Some other condition. Only these conditions satisfied, amalgamation and demerger will be tax free. If any one of these conditions is not satisfied, it will be classified as a slum sale. And accordingly, capital gain will be computed as per 50B. Okay. So this is slum sale. So how the capital gain will be computed? Normal computation will not work because it's a group of assets. It's a balance sheet, depreciable asset, non-depreciable asset, a deferred revenue expenditures, internal liability, external liability. So running business undertaking transferred for a single price. So usual way of computation is not possible. So they created a separate section. So how the capital gain will be computed? First, full value of consideration shall be the higher of fair market value 1 and fair market value 2. So we have to find out the full value of consideration separately. Actual consideration will be fair market value 2, and we have to find out the fair market value of the business undertaking on the date of demerger as per the provisions of income tax rule. So we should go to income tax rule 11. We have to find out the valuation. So that is known as FMV 1. And then it should be compared with FMV 2. FMV 2 is basically actual sale price, actual lump sum consideration. That is basically FMV 2. Compare the fair market value of the unit with actual consideration. Whichever is higher is the full value of consideration. From that, reduce expense for transfer. We will get the NSC. From that net sale consideration, reduce the cost of acquisition. Cost of acquisition of slum sale is net worth of the undertaking. So usual way of cost of acquisition not possible here. We have to find out the net worth of the undertaking. How the net worth will be computed? So net worth computation is simple. First, we have to take the balance sheet of the unit which is subject to slum sale on the date of slum sale. What is the balance sheet? Go to the asset side. Asset should be classified into 4 types: depreciable asset, non-depreciable asset, self-generated goodwill or similar type of assets, and 35 AD assets or fictitious assets. Total 5 category. Regarding depreciable asset, we have to compute or we have to take, if they are given, WDV as per section 32 or as per section 43 of the income tax law. What is the opening WDV? If slum sale is happened in 2024-25, then WDV as on 1/4/2024. Opening WDV of the current year should be taken regarding depreciable asset. If it is non-depreciable asset, consider the value given in the balance sheet, book value, but provided there should not be any revaluation. So book value excluding revaluation. If they made any upward revaluation or downward revaluation, revaluation should be ignored and take the original cost for non-depreciable asset like land, stock, debtors, etc. Depreciable asset, plant and machinery, furniture and electrical fittings, intangible asset, and building. We have to take WDV as per Income Tax Act. If they are not giving WDV as per IT Act, but they are giving the original cost of that asset and date of acquisition, then we must go to section 32, take the original cost, reduce depreciation under WDV method for those period to arrive at the opening WDV as on 1/4/2024 and then take that. If they directly given the WDV, take that. No WDV is given, no details to compute WDV, then there is no other way. Based on the available information, we will take assumption that the value given in the balance sheet is WDV as per ITI. No other way. For non-depreciable asset, book value you can take, original cost you can take, but there should not be any revaluation. And if there is any 35 AD asset is there, we should take it as nil, because for the 35 AD asset, probably assessed would have been claimed the entire cost as deduction under 35 AD in the year of acquisition. So further there will be no cost, there will be double deduction. So 35 AD asset, the cost will be taken as nil, value should be taken as nil. Self-generated goodwill, value should be taken as nil. And if there is any purchased goodwill, then we can take the purchase price as the cost of acquisition, not only for goodwill, any other similar type of patent, etc. like that. If it is purchased, purchase price can be taken. But generally for patent and trademark, etc., we can claim depreciation. That is a depreciable asset. So we will get only the WDV only we will take. But similar to self-generated goodwill, if there is any other type of asset where the section 55 says that actual cost should be taken as 0, then such item we should take 0. Deferred revenue expenditure do not consider. Deferred revenue expenditure will not be considered as an asset for the purpose of net worth calculation. So these are the assets. Take the total. From this total assets, reduce external liability. External liability means the bank loan, debentures, deposits, sundry creditors, etc. Share capital is internal liability, do not reduce. Reserves, do not reduce. So only external liabilities we have to reduce. So if the balance is positive, that is known as the net worth, that is the cost of acquisition. It should be positive. If the net worth is negative, then cost of acquisition should be taken as 0. Usually net worth will be positive. So value of asset should be more than the value of liability, then only it will be positive. So that net worth should be taken. no indexation benefit will is available because practically indexation cannot be given. How you will claim the indexation, right? Depreciable asset, non-depreciable asset, right? Different point of time assets are acquiring. It is a running business undertaking. Different point of time assets are acquiring, and we are reducing liability also. Then how you will claim indexation? That is practically not possible. That is why no indexation is given. To determine long term or short term, because once we compute the capital gain, we have to compute the rate of tax. So tax liability we have to compute. So to determine long term or short term, we should see the period of existence of the undertaking. If the undertaking is in existence for more than 24 months, if the transfer date is after 23rd July, if the transfer date is prior to 23rd July, more than 36 months, then long term, otherwise short term. So this is the valuation of net worth. That is actually easy part. This is actually easy part. Now we should go to find out how the full value of consideration will be taken. So we have to go to the fair market value 1 computation and FMV 2 computation. Literally, FMV 2 computation is very easy. FMV 1 computation is very important, right? So how we will find out the fair market value 1? So to get the fair market value 1, first step is take the asset side total. Take the book value of assets, balance sheet, asset side total. From that total of balance sheet, asset side, book value, reduce these assets. Why we are reducing? Because we will value it separately. That is why we are reducing. And some items not at all treated as an asset. That is why they are eliminating. So jewelry and artistic work, we will reduce from the total of balance sheet assets total. The reason is nothing. We will value it separately. That's why. Jewelry and artistic work, shares and securities, we value separately. Immovable property, we will value separately. All these 3 items must be taken, reduced from the book value of asset and take it separately. Income tax paid minus refund, never considered as an asset. So reduce, directly reduce and do not take it anywhere else. Leave it, reduce. Unamortized deferred revenue expenditure, never treated as an asset, reduce. So balance book value of assets, that will be classified as A. So for example, if the balance sheet asset side contains 100 crore, we reduce to jewelry, shares, immovable property, all these 3 together 30 crore. So 100 minus 30, 70. Out of this 70, income tax refund or income tax paid minus refund 10 crore. So 70 minus 10, 60 crore. Unamortized expense 5 crore. So 60 minus 5, 55. That 55 means book value, balance sheet value of the remaining assets. Remaining assets means other than jewelry, artistic work, shares and security, immovable property, all other assets, book value. That's the meaning. So what is for jewelry and artistic work? You have to take the open market value as per the registered value certificate. Open market value of jewelry and artistic work should be taken. Shares and security, you should find out the intrinsic value as per income tax rule 11 UA. Intrinsic value, net asset value. Go to the balance sheet of that private company or public company, which is the shares of that security related to which company. Go to that company. If it is that a listed company, go to share market, take the price in the share market. If it is an unlisted share or unlisted company share, take the balance sheet, find out the intrinsic value. How the intrinsic value is find out? Assets minus liability divided by paid up share capital. That is intrinsic value. That should be taken. That is rule 11 UA says. Fair market value of shares and securities. And for immovable property, we have to consider not the book value, stamp duty value. So jewelry, artistic work, do not consider book value. Reduce the book value from the total book value and find it separately, open market value. Shares and security, we cannot take the book value, find out rule 11 UA intrinsic value. And for immovable property, we cannot take the book value, take the stamp duty value. This is the reason why these 3 items are reduced to first. Take it separately. Income tax paid, not an asset. Unamortized deferred revenue expense, not an asset. Eliminate. So remaining book value plus these 3 item market value total, we will get total value of assets. Now to identify the FMV1, the next step is from this reduce book value of external liability only. So what are the external liability? They are saying only external liability need to be reduced. So these items are not external liability. What are not treated as external liability? So take the liability set total of the balance sheet. From that, eliminate these items. Remember, these are elimination. Paid up share capital plus securities premium, reduce. Proposed dividend, reduce. Reserves and surplus, reduce. But if there is depreciation reserve, you should treat it as liability. So other than depreciation reserve. Provision for tax minus refund claimed if there is any provision for tax, reduce. Provision for unascertained liability, reduce. Contingent liability, But only one contingent liability you can consider as liability, that is arrears of cumulative preference share dividend. So any other contingent liability, reduce. We will get book value of liability. Liability, there is no market value concept, so book value of liability. But these items are not treated as liability, so eliminate. So remaining liability we will get. So this liability should be reduced from A plus B plus C plus D. A, book value of certain assets. B, market value of jewelry, artistic work. Z, market value of unlisted shares or listed shares. And D, stamp value of immovable property. That is A plus B plus C plus D minus this liability L. We will get FMV1. So some people are selling their business undertaking at a very low price to evade the tax. Actually, they are making the slum sale for 300 crore. 250 crore they will show in agreement through bank statement. They will transfer. Balance 50 crore they will arrange by cash or some other illegal transactions. So they will say it is transferred for 250 crore. So thereby they can reduce the capital gain. So to prevent that, they are making this. If we make the valuation as per income tax rule, the fair market value may be 300 crore or 350 crore. So 350 crore or 250 crore, whichever is higher, full value, 350 crore. So to prevent the practice of reducing the actual sale consideration in case of slum sale and thereby reducing the tax, to prevent that, they put this condition, because FMV will be more. If the actual sale price is manipulated, FMV will be more. So which will be taken as the full value of consideration. Then what is FMV2? FMV2 means actual sale consideration. There is also a possibility of fraud. I am transferring my unit as a slum sale, under slum sale. The sale consideration fixing is like this. You have to give me 200 rupees money. You have to give a land worth 50 crore. You should give 1 kg gold. And you should give some shares of these companies. If you give all these 4, I will give my business as a slum sale. This is the consideration. So sometimes consideration may not be 100% in money. That is why they put FMV2. So what is FMV2? Monetary consideration received as slum sale consideration plus, if you get jewelry, sculptures, etc., take the open market value. You are getting shares and security, same valuation as above, market value. If you get any immobile property, that is a stamp value. If you get any other movable property, open market value. Take the total. That is the money value equivalent to non-monetary consideration plus money consideration received for slum sale, total. This is FMV2. So FMV1, purely market value. FMV2, actual consideration received by way of money plus non-monetary total. Which is higher is the full value of consideration. So this is where full values arrived. Now reduce the expense for transfer, you will get the NSC. From that NSC, we can reduce cost of acquisition, which is net worth. Net worth should be computed separately. That we already discussed. So we will reduce, we will get the capital gain. Got the idea? Now we can go to that question. So PQR Limited has 2 units, one engaged in manufacture of computer hardware and the other involved in developing software. As a restructuring drive, the company had decided to sell its software unit as a going concern by way of slum sale for rupees 385 lakhs to a new company called S Limited, in which it holds 74% equity shares. Actually, the seller already having 74% share in the buyer company. That is for the purpose of a tax planning is given. That we'll discuss separately. First, we have to compute the capital gain on slum sale. Only one division is transferred. That is, they are selling the computer hardware division. They are selling, software division they are selling for rupees 385 lakhs. So it's very clear. There is no monetary consideration. Only monetary consideration is there. So 385 lakhs is known as FMV2. FMV2. 385 lakhs FMV2. FMV1 we have to find out, then we can find out the full value of consideration. Okay. Now, balance sheet as on the date of slum sale is given. So, hardware unit, fixed assets, software, debtors, inventories. So, fixed assets, debtors, inventories. No detailed assets is given, just some classification. Liability set, paid up share capital, general reserve, share premium, revaluation reserve, current liabilities, hardware unit, software unit. So, external liability seems to be only current liabilities. Following additional information are furnished by the management. Software unit is in existence since May 2015. So definitely long term. Long term. Fixed assets of software unit includes land which was purchased at 40 lakhs in 2017 and revalued to 60 lakhs as on 31st March 2025. The stamp duty value on 31st March 2025 is 55 lakhs. So we have to consider for net worth purpose, we have to consider only 40 lakhs. And for FMV1 calculation, we have to consider 55 lakhs. And all remaining assets, we can take it as non-depreciable asset, because next paragraph they are saying fixed assets of software unit mirrored at 140. That is 200 minus 60. 140 is a WDV of depreciable asset, that is furniture and plant and machinery as per books. We does not require book value. However, the WDV of this asset as per Income Tax Act is 90 lakhs. So for computing net worth, we should consider this 90. As a time, tax liability which would arise from slum sale to PQR Limited, assuming it does not opt for section 115 BAA. And next one is tax planning. So first we will go to the capital gain computation. We have to compute the FMV1. For FMV1 purpose, first we should take the asset side total of a software unit. So asset side total of software unit here 200, 110, 35. So what is 200 plus 110 plus 35? 345 plus here only land we can immovable property we have to reduce, right? Land. So what is the book value of land in this 345? 60, right? 60. What is the balance? 345 minus 60. 285. Plus for land we have to take the stamp value. What is the stamp value? Stamp value 55, right? Yeah, 55. No jewelry, no shares. We got FMV1. Not FMV1, we have reduced liability also. So 285 plus 55, how much? 340. Plus only one external liability, L, 90. So actually we can do in other way, that is we have to take that entire 750 minus, anyway we have to reduce hardware unit, that is not to be considered here, 40. Balance will be 710. From that reduce capital 300, GR 150, share premium 50, RR 120. Get the same amount L. What's the balance? Will be 90, right? Correct? 90. L 90. So this is 340 is A plus B plus C plus D. So this is L. FMV1. What is FMV1? 250. FMV2 385. Whichever is higher? Yeah. Full value of consideration rupees 385. Now cost of acquisition, net worth. So we have to take the depreciable asset WDV as per IT Act. So regarding the land we have to take the original cost. So out of fixed assets of software unit 200, we have to take land. So land we have to take the original cost, that is 40. And for other depreciable assets, we have to take the WDV as per Income Tax Act, that is 90. So fixed assets is over. Now software debtors 110, software inventory 35. Value of assets. So total 275 minus external liability 90. 185. This is net worth. So we got long-term capital gain. How much? 200 lakhs. Ascertain the tax liability. Okay. So it is a company, it does not opt for 115 BAA. So the tax rate for long-term capital gain, we have to see the date of transfer. The date of transfer is 31st March 2025, right? Yeah. So after the amendment, long-term capital gain will be taxable at a flat rate of 12.5%. Even prior to amendment, there is no indexation. After also no indexation. But anyway, long-term capital gain rate of tax is different. So 12.5% tax. And if the total income of a company exceeds 1 crore but does not exceed 10 crore, they are liable for a surcharge of 7%. So 12.5% tax plus 7% surcharge plus 4% health and education cess is the tax liability. So you have to say the tax liability also. 2 crore into 12.5% tax, 7% surcharge on tax, and the tax plus surcharge 4% cess. Including cess, 27.82. This is the first part of the question. And question asking for a second part. What would be your advice as a tax consultant to make the restructuring plan of the company more tax savvy without changing the amount of sale consideration? Okay, without changing the value of 385 lakhs. Actually, it is a sale for 385 lakhs. But how you can avoid the tax, or how you can plan the tax? So practically, the possibilities are total. Two possibilities are there. Two possibilities. Possibility number one, as per the provisions of section 47. If capital asset is transferred by a holding company to subsidiary company or subsidiary company to holding company for a consideration actually transferred, it will not be treated as a transfer and there will be no capital gain liability. Even though it is a real sale, there will be no liability. Condition, holding company shall hold 100% shares of subsidiary. Number two, the purchasing company must be Indian company. Number three, for the next 8 years from the date of transfer, holding company shall continue to hold 100% shares of subsidiary. Condition number four, the capital asset purchased by which company, whether holding or subsidiary. Holding to subsidiary transfer, then subsidiary is the recipient company. Subsidiary to holding, holding is the recipient company. That recipient company should not convert that capital asset into stock in trade within a period of 8 years from the date of transfer. If these four conditions satisfy, actually two conditions are subsequent conditions or future conditions. Immediate two conditions is only there. Number one, holding company shall hold 100% shares of the subsidiary company, and the capital asset receiving company must be Indian company. If these two conditions satisfied, we can apply section 47. It is not a transfer, and there will be no tax liability. So here, the seller company already hold 74% equity shares of the buyer company. So PQR Limited is holding 74% equity shares of S Limited. Here S Limited is the buyer. So if it is possible, before making slump sale, try to purchase the remaining 26% shares of S Limited by PQR Limited. So if they purchase remaining 26% shares, then S Limited will become a wholly owned 100% subsidiary of PQR Limited. Then after that, make the slump sale for 385 lakhs, sell off the division, no tax, zero tax. This is the first possible tax planning. And the second possible, so suppose we have to write, if that is not feasible, suppose the shareholders are not ready to sell off their balance 26% shares to PQR. So then this will not be worked. But as they are holding 74%, it is the easy way. So this should be the first tax planning you should mention. Second tax planning, do one thing. If this is not possible, instead of making it as a slump sale, make it as a demerger plan. Make it as a demerger plan. So this division should be transferred to the other unit by way of a demerger. So instead of accepting consideration of 385 lakhs by way of money, accept the consideration by way of shares in the new company. So make the software unit as a resulting company, make it as a demerger. So at the time of demerger, if capital asset is transferred as per section 47, it will not be treated as a transfer. So these are the two possible ways. Amalgamation not possible, because to make it amalgamation, the old company completely should be merged with the new company. Here that is not possible. They want to continue with the hardware. Only software they are selling. So the only possibility is demerger or holding subsidiary. So first tax planning holding subsidiary, second one is demerger. So demerger, all the conditions of demerger should be satisfied. Then transfer. Okay, as part of demerger, transfer this division, make it as a resulting company, then there will be no capital gain liability. So these are the major area we have to keep in mind under slum sale related issues. And now for the final point of view, we have to remember the other sections under section 47. As per the provisions of section 47, the major business restructuring transactions are outside the scope of capital gain liability. One is that is amalgamation. Another one is demerger. Another one is holding subsidiary. Next one is a succession of proprietary business by a company. Another one is succession of a firm's business by a company. Another one is private company or unlisted public company can be converted into LLP, conversion. So these are the major restructuring transactions which is permitted as tax free under section 47, subject to lot of conditions. So first one is amalgamation. At the time of amalgamation, amalgamating company or the vendor company, old company, transferred their crores of assets, capital assets, to the new company in a scheme of amalgamation. And the old company shareholders are getting shares as consideration, and the old company itself is getting PC, purchase consideration, and the entire assets is transferred, including capital assets, transferred to the new company. So there is a huge amount of capital asset transaction is carried out, but no tax will be applicable as per 47 condition. The new company must be Indian company, amalgamated company must be Indian company, and shareholders holding at least 75% shares of the old company, amalgamating company, shall become shareholders in the new company. So in the new company, they may not get 75% shares, that's not a problem. But all the shareholders holding, persons holding at least 75% shares of the old company shall become shareholders in the new company. Even with the 10% or 20%, that's enough in case of amalgamation. But the persons holding 75% major shares of the old company shall become present as shareholders in the new company. And all the assets and all the liabilities of the amalgamating company must be taken over by the new company. So selected assets and selected liabilities taken, all others are not taking. No, that is not possible. All the assets and all the liabilities of the old company must be taken over by the new company. And the next condition is the consideration towards the shareholders of the amalgamating company must be discharged only by way of shares. If these conditions satisfied, transfer of capital asset in a scheme of amalgamation will not be treated as a transfer for the purpose of tax law. Accordingly, there will be no capital gain liability, no capital gain tax. If all these conditions satisfied, there is a bonus also. One more benefit you will get. The primary benefit is there will be no capital gain tax. So the second benefit is, if all these conditions satisfied, brought forward business loss and unabsorbed depreciation. Here remember, brought forward business loss does not include speculative loss. Other than speculative loss, all other brought forward business loss and unabsorbed depreciation of the old company shall become the business loss and unabsorbed depreciation of the new company in the year in which amalgamation took place. That means the new company will again get another 8 years to carry over the brought forward loss of the old company. So if old company gets a brought forward loss, carry over, this is the last year, 8th year. At the 8th year, amalgamation happened. The new company will again get 8 years. So total, that loss will be available for how many years? 16. That's a fantastic tax planning enjoyed by loss-making company. At the time of amalgamation, the new company, they are enjoying this tax benefit. Sometimes Reliance or similar type of large group, they will acquire some small groups. So people will wonder why they are acquiring this loss-making company, because they need the loss. They need the loss to set off with the profit, right? They will again get 8 years. It's a fantastic tax planning. But regarding unabsorbed depreciation, already there is no time period for restriction, right? There is no restricted time limit. Infinite period you can carry forward. So that will also be available to the new company. But old companies, business loss, except speculative loss and unabsorbed depreciation only will be allowed to the new company. Capital loss, not allowable. House property loss, not allowed. Speculative loss, not allowed. Owning and maintaining resource loss, not allowed. So only these two losses, business loss and unabsorbed depreciation of the old amalgamating company, can be claimed by the amalgamated company, and it can again carry forward for the next 8 years, because Act uses the word, the brought forward losses of the old company will be treated as current year losses of the new company. That is why they are getting again 8 years. Otherwise, they will get only balance. This is amalgamation, second tax planning. And third one, whatever capital assets of the old company taken by the new company, all those original cost of acquisition of the old company can be claimed by the new company. And for the depreciable assets, WDV of the IT Act, as per the old company, can be claimed as actual cost of the new company. They can continue the depreciation on that value. Intrinsic value or revalued figure of depreciable asset will never be permitted. Old company's WDV continued in the hands of the new company. Or capital assets in case of land or similar type of assets, old company's original cost can be claimed as a cost of acquisition of the new company, and whether to determine long term or short term, old company's holding period will also be counted for the new company. And if the new company transferred this land or building before 23rd July, they will get exemption, so they will get indexation benefit. For the old holding period also, they will get the indexation benefit if we apply the Manjula J. Shah's decision by Bombay High Court decision. So these are the major advantages available in case of amalgamation. Subsequently, the new company has to comply certain additional condition. New company must continue the same business for the next 5 more years, and the substantial assets of the new company should not be transferred by the amalgamated company. There are certain additional conditions regarding loss carryover. If that condition is also satisfied, then only these loss will be available for the subsequent 8 years. In between that 8 years, any subsequent condition prescribed under section 72A is violated, then this loss already set off by the new company will be retaxable as income, and remaining losses will lapse. So remember, for capital gain, there is no subsequent condition. But to carry over these losses of the old amalgamating company by the amalgamated company, there are certain subsequent additional conditions prescribed in 72A. Any one of that condition violated, this loss will not be allowed to carry forward further. And in addition to that, if already set off any loss of the old company by the new company, that will be treated as deemed as retaxable as income, business income. Okay. Then this is the restructuring for amalgamation. Demerger. Same way. Demerger, the old company known as demerged company, new company is known as resulting company. In case of demerger, demerged company will survive even after demerger, because only a particular division is transferring. But in case of amalgamation, it's not like that. Old company is no more, merged completely. Demerger, only a division is splitting. So old company will be there, demerged company, new company is arising, resulting company. So those capital assets of that particular division transferred to the resulting company, not a transfer. In lieu of that, old company shareholders will get shares in the resulting company, not a transfer. That share exchange, not a transfer. Capital asset transfer, not a transfer. There is no subsequent condition, nothing like that. And this demerged company's business loss and unabsorbed depreciation will be available to the resulting company, not for fresh 8 years, balance period only. Balance period only. So in case of demerger, the government is not promoting demerger that much. So in case of merger or amalgamation, there is some synergy effect, right? In case of demerger, it's not like that. So the volume of that old company is reducing. So government is saying only for the balance period, the business loss of the demerged company will, which is attributable to that particular division, which is subject to demerger, will be allowed to resulting company for the balance period only. So if already the loss of that particular division is 6 years old, only the new company will get balance 2 years. So not again will get fresh 8 years. That's available only for amalgamation, succession, and conversion of company to LLP. These 4 cases only that is available. Demerger, only remaining period, resulting company will carry over that loss. Here also business loss and unabsorbed depreciation only. Other losses of the demerged company not possible to carry over by the resulting company if that loss is related to that particular division which is subject to demerger. Now the next third one is that is a conversion of company into limited liability partnership. If a private company or unlisted public company converted into a limited liability partnership. So listed company is not permitted to convert into LLP. Only a private company or an unlisted public company can become an LLP. In that situation also it is a restructuring. We can call it as conversion. So all the capital asset of the old company will be transferred to the LLP. It will not be treated as a transfer. There are a lot of condition. All assets and liabilities must be transferred, and all the shareholders in the old company shall become partners in the new LLP. Their consideration should be in the form of share in profit sharing ratio and share in capital contribution. All the shareholders together, as a partner, their total shareholding, profit sharing ratio in the new LLP should not be less than 50% of the total profit of the new LLP. And it must be continued for the next 5 years. And any accumulated profit of the company taken over by the LLP, it should not be distributed among the partners within a period of 3 years. And book value of asset of the old company in any of the 3 years prior to the date of conversion should not exceed 5 crore. If all these conditions satisfied, conversion of company into LLP not treated as transfer as per section 47. Accordingly, no capital gain liability. Number two, the brought forward business loss and unabsorbed depreciation and unabsorbed capital expenditure on scientific research and unabsorbed capital expenditure on family planning available with the old company can be taken over by the LLP, and it will again get another 8 years to carry over. But if any one of the subsequent condition is violated, subsequent condition is within the next 5 years, the total profit sharing ratio of the partners in the new LLP should not come down below 50%. If that condition is violated, exempted capital gain earlier will be retaxable in the hands of the LLP, and any losses taken by the LLP will lose. And if any balance loss is available which belongs to the old company, it shall lapse. And if already set off, then that will be retaxable as business income. So these are the provisions related to conversion of company into LLP, private company or unlisted public company into LLP. Now, succession. A proprietorship is taken over by a company. So the proprietor, all the assets and liabilities of the proprietor must be taken over by the company. The proprietor shall become shareholder in the new company. His total shareholding in the new company should not be less than 50%. It must be continued for the next 5 years. If all these conditions satisfied, the transfer of capital asset by the proprietor to the company will not be treated as a transfer, and there will be no capital gain liability. And second one, the business loss and unabsorbed depreciation available with the proprietor will be available to the company, and company will get again 8 years regarding business loss, and for unabsorbed depreciation, infinite period they can carry over. Within next 5 years, if the profit sharing of the ratio of the proprietor in the new, or the shareholding pattern of the proprietor in the new company come below 50%, then whatever capital gain exempted earlier in the hands of the proprietor will be retaxable in the hands of the company. Similarly, any losses available shall lapse, and if already set off any losses before violation, that loss will be retaxable as income in the hands of the company. So even though capital gain exemption enjoyed by predecessor, capital gain retaxable in the hands of the successor only, company only. But regarding loss, if advantage taken by the company, it will be retaxable in the hands of the company itself if subsequent condition is violated. Now the next one is partnership firm is taken over by company. Succession of a firm's business by a company. Same. All the assets and liabilities of the S2L partnership firm must be taken over by the company. All the partners in the firm shall become shareholders in the new company. Their total shareholding in the new company should not be less than 50% of the total capital of the company, and it must be continued for the next 5 years. If these conditions satisfied, the transfer of capital asset by the firm to the company, not a transfer. Number two, any unabsorbed depreciation and business loss, unabsorbed depreciation and brought forward business loss, except speculative loss, available with the partnership firm shall become the business loss and unabsorbed depreciation of the new company in the year in which that conversion took place, and the company will again get another 8 years to carry forward regarding the business loss. But if within the next 5 years, if the shareholding pattern of the partners in the new company come down below 50%, then whatever advantages taken by the firm, that is capital gain exemption, retaxable in the hands of the company, and loss taken by firm will lose, and if any balance loss, it shall lapse, and if already set off, retaxable as income. So I think this was the compulsory question they asked in the last year, right? Last attempt they asked the question on this area, that is conversion of partnership firm into company. along with the 35 AD and 10 AACZ and this condition, this shareholding pattern condition. So these are the provisions regarding partnership firm is taken over by the company. So these are the major restructuring provisions mentioned under section 47. And now the next area, I think the major areas regarding capital gain we discussed. So just I will check whether there is any other relevant area. Yeah. So 45(1) chargeability, 45(1) insurance compensation, 2 conversion of capital into stock and trade, 3 and 4 partnership to firm and firm to partner, 9B firm to partner, and 45(5) compulsory acquisition, 5A joint development agreement discussed, and 46 liquidation of a company. At the time of liquidation of a company, if assets are distributed to the shareholders, there will be capital gain for the shareholder, not for the company. So what is the fair market value of asset received from the company at the time of liquidation plus money received minus deemed dividend? The remaining amount is taxable as full value of consideration for the shares of the shareholder. What is the cost of acquisition of shares in the company originally? That can be claimed as cost. Remaining capital gain taxable in the hands of the shareholder. That is 46. Liquidation. Not treatment for company, treatment for shareholder. 46 a buyback. Buyback is nowadays not that much relevant because after 1st October 2024, if a company is making buyback in the hands of the shareholder, it is taxable as dividend under section 222F. Further, the cost of acquisition of that share can be claimed as capital loss. So 46A not that much relevant. 47 we discussed. 48 computation, 49 cost of previous owner, that is gift, will, inheritance, amalgamation, demerger, partition of HUF, holding subsidiary, etc. Cost of previous owner, cost of assessee. Holding period of previous owner, holding period of assessee. 50 capital gain on depreciable asset. 50 AA, very important, we discussed. Specified mutual fund, market linked debentures, unlisted bonds and debentures after 23rd July. 50B slump sale we discussed. 50C stamp value 110% symbol we discussed. 50CA, if unlisted shares of private company transferred for a consideration which is less than the fair market value. Here fair market value shall be determined as per income tax rule. Again intrinsic value. Then fair market value shall be deemed to be full value of consideration. Deeming provision. Because listed shares you cannot sell at lower than market value because it is listed. You can buy and sell only through stock exchange. So the price is determined by market. You cannot manipulate. But private company, private sale between two party. If that two party agreed, they can manipulate the price. Balance money can be paid in cash, black money. They can reduce the full value. They can reduce the capital gain. To prevent that, if actual consideration is less than the fair market value deemed to be full value. That is 50CA. And 50D, when a person transferred a capital asset and there is a consideration, but the consideration is not ascertainable. For example, I am transferring a land. The return consideration, he will render me a service. So not monetary, not in kind. Some other activity he is rendering. So the consideration is not measurable. If consideration is not measurable, the machinery provision of income tax failed. We cannot compute capital gain. Lot of high court decisions. So they created a provision, machinery provision. Okay, you transferred a capital asset. There is a consideration, but that consideration is not quantifiable, not ascertainable. Do one thing. The fair market value of transferred capital asset on the date of transfer deemed to be full value of consideration. That is 50D. 51. Advance money received and forfeited. If prior to 1/4/2014, if a person received advance money and forfeited prior to 1/4/2014, if advance money received and forfeited by assessee, then it should be reduced from cost of acquisition of that capital asset. But if advance money received on or after 1/4/2014, it will be directly taxable under income from other source. If advance money received and forfeited by previous owner prior to 1/4/2014, father forfeited advance money and later property gifted to son, and son is assessee now. So here advance money forfeited by father, that is a previous owner. So if that advance money forfeited prior to 1/4/2014, there is no provision under the income tax law. Nothing can be done. No tax treatment. It is not taxable anywhere under the provisions of the income tax law. So no treatment. So prior to 1/4/2014, advance money received and forfeited by assessee reduced from cost of acquisition. Prior to 1/4/2014, advance money received and forfeited by previous owner, no tax treatment. On or after 1/4/2014, advance money received and forfeited, directly taxable under income from other source. And section 55 deals with certain basic provisions. If a capital asset is acquired prior to 1/4/2001, its cost of acquisition shall be original cost or fair market value as on 1/4/2001, whichever is higher can be taken. Because indexation starting from 2001 to onwards only. So prior to 1/4/2001, there is no indexation. So that is why if a capital asset is acquired in 95 and transferred in now while computing capital gain, cost of acquisition shall be 95 original cost or fair market value as on 1/4/2001, whichever is higher. But if it is a land and building, this is not the rule. If it is a land and building acquired prior to 1/4/2001, first you should take the original cost, then compare two other figures. Fair market value as on 1/4/2001 or stamp value of that land and building as on 1/4/2001 if available. If available. If stamp value not available, general rule, FMV cost whichever is higher. If stamp value available, stamp value or FMV whichever is lower, FMV or stamp value as on 1/4/2001 whichever is lower, compared with the original cost whichever is higher can be claimed. Again 55 says that any improvement incurred prior to 1/4/2001 will never be allowed under the income tax law. Improvement incurred prior to 1/4/2001 not allowed in any case. Again 55 says if a person acquired a bonus share unlisted prior to 1/4/2001, unlisted bonus share, its cost of acquisition shall be fair market value as on 1/4/2001. But if a bonus share is allotted, unlisted bonus share is allotted after 1/4/2001, then its cost of acquisition shall be taken as 0. If it is a listed bonus share, long term and STT paid, then it will be governed by 112A. Otherwise, it will be governed under section 111A. If it is listed short term. And then 55 says, self-generated goodwill. And if you obtain some patent, self-generated patent, similarly self-generated technology, you invented a technology, you obtained a copyright or patent, self-generated copyright, root permit, etc. If it is self-generated, always the cost of acquisition must be taken as 0. Always the cost of acquisition must be taken as 0. Even though it is self-generated prior to 1/4/2001, fair market value substitution not possible. Always the cost of acquisition is 0 if it is self-generated. But if you purchased these items from any other person, purchase price can be claimed as cost of acquisition. That is also mentioned in section 55. 55A, not that much important. There are total 3 situations where the assessing officer refer a particular case to the valuation officer to find out the real market value of a capital asset if there is a dispute between assessee and AO. So AO can refer the case to valuation officer. So valuation officer can find out the value and give the report to the AO. That is section 55A. Power of AO to refer to valuation officer to find out the fair market value in certain cases. That is 55A. So 112 deals with the tax rate. Prior to 23rd July 2024, long-term capital gain will be taxable at a flat rate of 20%. After 23rd July 2024, long-term capital gain will be taxable at a flat rate of 12.5%. But in respect of resident individual and resident HUF for land and building, there is an option. If they claim indexation at 20%, without indexation 12.5% after 23rd July. And regarding 112A, long-term capital gain from listed equity shares, STT paid both at the time of purchase and sale of shares. In case of equity-oriented units of mutual fund or units of business trust, need to be paid only at the time of transfer only. It should be long-term. More than 12 months it is held. In that situation, capital gain must be computed in a special manner as per 112A. Such a long-term capital gain up to 1,25,000, it will be treated as nil. Tax rate is nil. In excess of 1,25,000, the tax rate will be 10% or 12.5%. If the transfer is prior to 23rd July 2024, the rate will be 10%. After 23rd July 24, the rate of tax will be 12.5%. But anyway, prior to 23rd July or after 23rd July, for the previous year 24-25, up to 1,25,000, its tax rate is nil. Remember, it is not an exemption, it is a rate. So while you compute the total income, it should be there. So don't say exempt. If you say exempt, it is absolutely wrong. Exempted income will never forming part of your total income. This 1,25,000 is a rate of tax, nil, just like basic exemption, up to 2.5 nil, up to 3 nil. So it is nil, not exempted. So excess of 1,25,000, 12.5% or 10% depends upon the date of transfer. Prior to 23rd July, 10. After 23rd July, 12.5% only on the excess. And under section 112A, remember, while taking cost of acquisition, if these securities covered under 112A is acquired prior to 1st February 2018, the cost should be taken in a special manner. Original cost, then comparison with the fair market value as on 31st January 2018, or full value of consideration, whichever is lower. That lower compared to original cost, whichever is higher. But if these securities acquired after on or after 1st February 2018, then simply take the original cost. No indexation in 112A. Further, the rate of tax under 112 is flat rate. Against that rate of tax, you can't claim 87 a rebate even though you are resident. But other 112 long-term capital gain, even 111A short-term capital gain, you can claim rebate under section 87A. No prohibition. But from 112A, you cannot claim rebate. Now section 111A, short-term capital gain. See, if 112A long-term, 111A is short-term. So listed equity shares, equity-oriented units, unit of a business trust, which is a short term, held for less than 12 months. STT paid, then 111A. So 112A long term, if that is short term, 111A. Simply we can say that. There is some differences. In 111A, regarding shares, STT paid only at the time of transfer only. No need to pay STT at the time of acquisition. But in 112A, regarding shares, listed shares, STT should be paid both at the time of acquisition and sale. There are certain exceptions. In case of direct recruit from direct issue of shares from SEBI or central government or RBI or bonus share or IPO, in those situations, even though STT not paid at the time of acquisition, still 112A applicable. Similarly, in IFSC, there is no STT, but still 112A applicable. Otherwise, generally regarding shares under 112A, STT must be paid both at the time of acquisition and at the time of transfer. But in 111A, STT need to be paid only at the time of transfer only. No need to pay STT at the time of acquisition. 111A rate is also amended. Prior to 23rd July 2024, if there is a short-term capital gain under section 111A, it will be taxable at a flat rate of 15%. 15% flat rate. But after 23rd July, it will be taxable at a flat rate of 20%. 20%. So 15-20. That is the tax rate under 111A. Regarding 112 and 111A, other than even 112A, in all these three, flat rates. But if you are resident individual, your other taxable income is less than the basic exemption limit. You have a salary, HP, PGBP, IFOS, or even short-term capital gain, normal short-term capital gain, slab rate income. All those income, total income is less than 2,50,000. So there is a unutilized basic exemption available. That unutilized basic exemption can be adjusted against this flat rate income only if you are resident. So unexhausted basic exemption can be adjusted against this flat rate income only if assessee is a resident. And now tax planning, all provisions we discussed. The major area is 54 EC, F, GGA. Those are the major area. Usually they are asking EZ or F. Rare cases 54. And the next all other provisions we discussed. Okay. 1037, urban agriculture land used to minimum period of 2 years for agriculture purpose, compulsorily acquired by government, capital gain exempted. Okay. 214, definition of transfer, definition of capital asset, and 247, definition of transfer. Okay. So these are the provisions of capital gain. The major area is actually 45(1)(a), 45(4) and 9(b), very important. 45(5)(a), joint development agreement, very important. 46 is important, liquidation of company and asset distribution. Again, then 47, 50AA, 50B, slum sale, and then tax planning. And then 112A is important for final because they are asking along with the company assessment or those type of questions, and also asking for tax liability. So at that time, that area is also important. And in IFOS, buyback, reason provision, that is also very important. So if we got time, I will give an overall idea of IFOS. Okay. So now we can go for lunch break. After lunch break, we'll go to discuss the set off provision, I will take set off only regarding final area. We won't cover the inner area, right? So basics just I will tell, but we will go in deep set off provision. Set off is very important for final. Some of the area, especially after 72, 72A, 78, 79. These three area and section 80, very important. Okay.